Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua here in London, and here are your top stories. Fed speak sparks a sell-off. Lael Brainard sees a speedy reduction in the central bank's balance sheet. The hawkish tone sends global bonds tumbling. The G7 ramps up sanctions on Russia, while the EU plans to ban coal imports as the US blocks Russian investments. And we'll also get into the fallout from sanctions and look ahead to this Sunday's French election with Guntram Wolff, director of Bruegel, plus the UK labour market amid a cost of living crisis. We speak to Reed chairman James Reed. Now, first thing is first, let's take a look at the futures. We did have a bit of pressure on some of the Asian stocks. This is because of the more hawkish tone coming for Lael Brainard. That was yesterday, saying the bank will probably shrink its balance sheet at a more rapid pace than expected. Euro stocks futures, you can see, practically unchanged. Again, the mood, I guess, is one of wait and see. We expect more sanctions on Russia. We look at commodity flows. So we look at how it all plays out on the commodity spectrum. Of course, we look at oil. Of course, we look at some of the currency moves. Treasuries also extending a slump, pushing the 10-year yield to 2.6%. That's the highest level since 2019. I'm also looking at bonds, for example, in Australia and New Zealand, tumbling. Now, as the equity indices are starting to open, they're down 0.2% for the IBEX. Similar loss for the FTSE 100, but we'll wait those to stabilize a touch, and we'll look at elsewhere what we should be focusing on. Certainly, there's a global bond movement together with stocks. If the Fed surprises the markets if we start a repricing when it comes to, of course, the hawkish stance, won't be as unexpected. But of course, the fact that Lael Brainard said yesterday that inflation is paramount, it does add to central bank that could start trimming some of the balance sheet as soon as May. So we could see a movement not only in global equities, but in bonds quite quickly. This is your cross-asset check. The focus firmly not only on that 10-year yield, we were just talking about it, 25919. S&P futures, again, a little bit directionless at the moment. We'll see how they do when futures open up in the US, and then the Bloomberg Dollar Index, 1,202. Now let's get straight to our Bloomberg MLive managing editor, Mark Cudmore. Mark, you're looking at central bank balance sheet, extremely topical.
Absolutely, Francine. Lael Brainard made me do this, essentially, from her comments overnight. This is a chart overlaying. The white line is the combined central bank balance sheet of the four largest central banks in the world, the Fed, the ECB, the PBOC, and the BOJ. So that's the white line. Now, you can see over the last 15 years, it exploded. It's hard to see it back now, back in 2008 in the first teen crisis. And then it was kind of growing the whole time until the pandemic, about 20 trillion. Since then, it's gone to about 32 trillion now. It's gone a little bit higher over the last month. This is as of the end of February, in fact. So essentially, it's up about 60% since the pandemic. Really, really quite extraordinary numbers. Now, the blue line is the Msci All-Country World Index. And as you can see, over the last 15 years, there's been a relatively good kind of link or correlation between the two. Now, of course, the pathway to trading poverty is paved with naive overlay charts. And I would not want to suggest that correlation is causation. However, it is hard to argue the fact that the incredible liquidity that's been pumped into the system by central banks around the world, much of that has fed its way to financial markets. And certainly there is some reason behind the visual link here that equity markets have gone up because central bank balance sheets have exploded. And it's even more important that many investors think that's the most important reason, whether it's true or not. The fact that we are likely to get QT and that white line is going to likely to fall in the months or years ahead does mean that equities are set to probably have quite a tough year as investors around the world see those balance sheets shrink.
Mark Hudmer with not only the chart of the day, probably the week, if not the month. Our Bloomberg MLive managing editor, Mark Hudmer. Now, let's get more, of course, on some of the Fed movements. The Fed governor, Lael Brainard, sent shockwaves through markets when she said the central bank would start balance sheet reduction at a rapid pace as soon as next month. That, of course, dented sentiment across asset classes.
Given that the recovery has been considerably stronger and faster than in the previous cycle, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps compared with 2017 to 19.
Well, let's get into the key market drivers now with our markets editor, Christina Kino. Christina, it does seem like this is maybe a more or less predictable Fed. Is that fair to say? And what does it mean for all asset classes?
Absolutely, Francine. Just when we thought that the Fed couldn't surprise us anymore, here comes Brainard really going in with that concept of balance sheet tightening. And I think it's quite an important point to make, because I think up until this point, we've been fairly focused on the rate hike aspect of the Fed policy tightening, because we've had several Federal Reserve policy makers really emphasizing that aspect of policy making. But I think we've forgotten that there is also the balance sheet aspect to this. And so now it's really driving home the point that quantitative tightening is a concept that we really should be minding, because there are two levers that the Fed has at its disposal. And clearly, from Brainard's comments yesterday, they're planning to utilize both.
Yeah, why had the market not seen this coming?
Well, I think, Francine, you know, the concept or the focus really had been on rate hikes, partly because I think, you know, it's not really something that we've seen very recently. And so that was grabbing a lot of attention as really what's marking the regime shift in Federal Reserve policy over the past decade. You know, it really was all about quantitative easing the past decade and keeping those policy rates low. And so now that there was kind of this imminent shift in the policy rate aspect of it, I think that's really what kind of enamored a lot of market participants. But again, there's the balance sheet aspect of it, and potentially, you know, the combination of that, the rate hikes plus the balance sheet roll off, also depending on what they do first, really could be quite powerful.
Yeah, I'm sure a lot of market traders are also looking at what Deutsche Bank was saying, which is a recession in the U.S. within 2 years, I think.
Absolutely, Francine. And, you know, I think that recession talk is just going to grow louder now that it's really been driven home, the point that the Fed is very much committed to this tightening cycle. And I think now the discussion is probably going to be, it follows on from what we've seen from the yield curve discussions of the last couple of weeks as well, right? There's really this underlying worry about recession and how hard a landing we could see out of this tightening cycle that the Fed is about to embark on. And yeah, it's going to be interesting. Is the Fed going to be able to engineer a softer landing out of those rate hikes that will put the brakes on the economy, or are we in for a bit of a crash landing here, shall we say?
I mean, what happens in the event of a crash landing, actually? Again, do markets readjust ahead of what, you know, banks are repricing in terms of recession?
Yeah, you know, I think now that we have the recession discussion back on the table once more, I think, you know, you will get markets kind of trying to anticipate that, because this is the nature of markets, right? They really try to forerun all of these potential events a year or 2 years ahead. And so it could potentially be a situation where we see the repricing for that much, much earlier than the actual event. And so, you know, if we do get there, the actual event may not necessarily be as daunting to markets. And so we're really in kind of the crucial period now where markets are trying to anticipate what's going to happen to the U.S. economy in a year or in a couple of years. And that's where we start to see probably that pricing and those expectations shift.
I think our Bloomberg economist, Lisa Winger, was saying that U.S. company profit, for example, margins are going to narrow, but they probably won't lead to a recession in the U.S. So we'll see all the tensions there. All right, commodities. If we get extra sanctions, are we just going to see a lot more volatility in commodities if Russia gets punished more?
Yeah, I think that's a fair statement to make, Francine. I mean, we've already seen a lot of two-way risk in a commodity complex in general, just as a result of the tensions in Ukraine and the war that's ongoing. And so, you know, they're really at the forefront of the impact in terms of the financial market implications, given the role that Russia and Ukraine play in the global commodity complex. And yeah, I think it's fair to expect more two-way risk here. I do wonder, you know, again, in terms of kind of the commodity complex as a whole, of course, we've seen a lot of increases, but, the nuance is there. Is oil going to be rising as much as the other commodities in the space? Coal, natural gas. There's a lot of kind of individual sanctions that could potentially apply to each of these. And so we may get into a situation where we see not equal moves in each of them.
Great. Thank you so much. Our Christina Keener there, our Bloomberg Markets editor. Now, I'm just getting some breaking news out of the Hong Kong Chief Secretary, John Lee. He resigns. We're also looking at live pictures from Charles Michel, the president of the European Council. So we'll get to those breaking news shortly. Mr. Michel, I'm sure, talking about some of the sanctions, of course, that they will further impose on Russia. More on those stories next. This is Bloomberg.
The city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Welcome back to the Open, everyone. 11 minutes into the European trading day. Again, a lot of the European stocks, so we were expecting it to open lower, not by much, but of course finding their feet with this new line for Lael Brainard in terms of what they can do with the balance sheet. A more hawkish Fed is what we could see. So markets moving on the back of that. In the meantime, we're also seeing live pictures from the European Parliament over in Strasbourg. Of course, they vacillate between Brussels and Strasbourg. That is Charles Michel talking about extra sanctions or the sanctions that they've so far imposed. I don't know whether they will close more loopholes to make sure that they are playing out the way that Europe wants them to be in terms of sanctions against Russia. Now let's get the latest on the war in Ukraine. The US, EU, and G7 are coordinating on a fresh round of sanctions on Moscow following the discovery of civilian murders in Ukrainian towns. Well, joining us now is Bloomberg's Europe correspondent Maria Tadeo. So Maria, first of all, what's in the sanctions package and what concrete impact can it have?
Well, Francine, we're expecting, as you say, a new round of sanctions on the Russian Federation. A lot of this responding to those terrible, gut-wrenching pictures coming out of Bucha over the weekend. Now, there's two groups here. One is, of course, those led by the United States and the G7, which would prevent future investments in Russia. A lot of this is designed to really drain the Russian industry. And then, of course, you have the European ones, which we're expecting will be also approved and signed off today. Now, what we hear is that overall total, it will entail 10 billion euros of exports from Russia into the European Union, now blocked. Of course, that also means that coal ban. What we know, Francine, is that the way this is going to work, buyers will be given 3 months to wind down their coal contracts, and after that, they won't be able to sign new ones. The European Union says it will also block about another 10 billion euros of exports from the EU into Russia and key technology, also with this new sanctions package.
So, Maria, President Zelensky also accusing Russia of unspeakable atrocities. In this context, can peace talks between Russia and Ukraine continue?
Yeah, and Francine, they were supposed to happen this week. They were supposed to be ongoing. And of course, the idea is that both sides are still working on a diplomatic path. But if you listen yesterday to President Zelensky speaking in the United Nations, he's had very harsh words, essentially saying this is not just war crimes, this is genocide. Russia hates everything that Ukraine stands for. In the meantime, the Russians, by the way, continue to say all of this is fake and this is a propaganda campaign handled by the Anglo-Saxon media. So inevitably, Francine, this is going to make these talks very difficult. We're very far from a ceasefire. And if you look at the situation on the ground, well, the Ukrainians say they are preparing now for a major attack on the east of the country. This is the famous Donbas area that could be connected through Crimea, through that city of Mariupol, who has been now destroyed to the ground. Almost 80% is gone. And of course, very serious concerns about the fate of the civilians that still remain in the city of Mariupol.
Thank you so much, Maria, today there with the very latest on the ground. Now let's get back to the market impact with our markets editor, Christina Aquino. Christina, we're talking a little bit before about this, huge news from Lael Brainard, which is really leading to a global bond slump. The other thing we need to watch out for is actually, if you look at the bond slump, it means that there's a discount for the first time since 2008 in terms of the gauge of, in general, dropping below its par value. How are these technical, points important to bond traders right now?
Well, Francine, I think fixed income investors are really having to come to grips with this new order, where bonds are really not as reliable as a source of income as they probably used to be, especially when we've seen just the extent and the speed of the moves and the sell-off over the past 3 months or so. And so, I think now a lot of investors we're seeing are kind of starting to ask existential questions of, is there income left in fixed income type of questions. But I think, we've also kind of started to get to levels where they may start considering, I'm actually getting something after adjusting for inflation from my bond holdings, which is, quite a sight to behold.
Nice, right? It's like, I don't get 0.02% anymore. I almost get like 0.7. Is there a threshold, actually, that would mean a switching of position? So one of the things that we've been trying to explore is, of course, in absolute terms, stocks are always going to be more attractive until something happens with bond. Is there a threshold that people talk about?
Absolutely, yeah. I think I've seen the number 3% on the 10-year nominal treasury yield as a particularly key level to watch out for. That may start to be where investors will start to see bonds as slightly more attractive in relative terms to stocks. But, I think it's also important to, again, keep an eye on those real rates, because that's really probably the best gauge of how well your bond holdings are really compensating you for inflation at this point. I mean, inflation really will be the enemy of any investor who's geared more toward fixed income. And so it's going to be a very key level to watch. And so once you get to a point really where, again, you get even more income or finally getting income from your fixed income holdings, that could potentially trigger some of those switches that some investors are anticipating.
Christine, thank you so much. Christina Aquino, there, our Bloomberg Markets editor. Now, we're also looking at still those live pictures from the European Parliament in Strasbourg. We were just hearing from Charles Michel, and we'll keep a very close eye on exactly what he's saying in terms of new sanctions. They did say, or he said moments ago, that the EU should consider granting asylum to Russian deserters. So we'll have plenty more on that shortly. This is Bloomberg. Also coming up, China's COVID surge hits the world's second largest economy as services numbers activity slump to levels seen at the start of the pandemic. We'll delve into those details next as well. This is Bloomberg.
during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open, everyone. We are 20 minutes into European trading day, and this is what the picture looks like for a lot of these equities. Now, global bonds are slumping, of course, on the discount for the first time since 2008. This is on the back of the Fed Governor, Lael Brainard, signaling a quicker than expected rundown in terms of the central bank's debt holdings. Now, let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Elon Musk has refiled the disclosure of his Twitter stake to classify himself as an active investor. The change comes after the Tesla CEO took a seat on the company's board. He'd originally filed his 9% stake with the US regulator as passive. The social media platform, meanwhile, says it's to start internal testing on an edit function, something it says is the most requested feature by users. Bank of America plans to bring all its US workers, both vaccinated and unvaccinated, back to the office by June the 1st. Sources tell Bloomberg employees will still have some flexibility to work from home, but are strongly encouraged to collaborate with colleagues in person. The company recommends workers will be fully vaccinated, but it's not mandating it. Jetblue Airways has offered to buy rival Spirit for $3.6 billion, potentially spoiling an agreed bid by Frontier Group. The unsolicited proposal from JetBlue has the potential to reshape the landscape for ultra-low-cost air travel in the US. That's the Bloomberg Business Flash, Francine.
Laura, thanks so much. Laura Wright in London. Now, China's coronavirus outbreak is starting to hit its services sector. Activity contracted sharply in March to levels not seen since the first lockdown in 2020. Now, as daily COVID cases surge past to 20,000, Bloomberg Intelligence suggests that China's closely watched growth goal of 5.5% is unlikely to be hit. Well, joining us now is Bloomberg economist Eric Zhu. Eric, thank you for joining us. So the lockdowns adding more pressure on China's economy. What kind of growth can we realistically expect this year?
Yeah, we think this year's 5.5% target is going to be very hard, very challenging. Even before the recent lockdowns, we already see it as a very challenging target for this year. Now with the new, lockdowns, given the Shanghai situation is still quite serious, we haven't seen signs of the cases peaking yet. So this means the lockdown in Shanghai can still drag on for a while. And not to mention, other risks of the cases in Shanghai spill over to other regions. This could trigger more lockdown in other regions in China. So we think this is the worst situation since the Wuhan episode 2 years ago. So the domestic COVID outbreak adding substantial pressure on the economy.
So will China actually change its COVID zero policy?
I think they want to eventually, but right now probably they are not ready yet. If you compare Shanghai to Hong Kong, we see lots of a large part of the population are elderly persons, and many of them are under or unvaccinated. So this means a very vulnerable group if the outbreak get out of control, if you see the experience in Hong Kong in the past few months. So this could be a very high, human and health cost for China, which it cannot afford to take right now. So before China is ready, for wider vaccination, for better treatment, for more sufficient health care for, mild and severe cases, we don't think China will take the opening path right now. Probably the lockdown is still the most viable option for now. But they will open eventually. We think it takes time.
Yeah, so when and how, Eric, do you see China beginning such a policy switch?
Yeah, I think China's priority is now, to get the current outbreak under control as soon as possible. And at the same time, they want to, speed up the preparation for any opening in the future. Like I just mentioned, better vaccination, better treatment, more health care. And, you know, even if China chooses to open, it's not going to be a switch from 0 to 1 overnight. I think they're going to take a more progressive approach, probably starting with some regional trials from some areas which are better prepared and see how it's going, then, you know, can progressively expand to other regions in China. So, baseline for this year is still the status quo. They probably will maintain the targeted lockdown approach, but they can start with some regional small trials probably later in the year.
Eric, talk to me a little bit about Hong Kong. So it's going to start relaxing some of the COVID restrictions later this month. What does this mean for the wider policy, actually, in terms of, you know, would Hong Kong's reopening have any implications for the wider China?
Yeah, we think so. You know, Hong Kong's opening is definitely, you know, it's a positive for Hong Kong's growth outlook. So after a deep slump in the first quarter, we think the second quarter, if Hong Kong do, you know, start to open up smoothly, this can raise the recovery path for Hong Kong. And also for China, this, you know, Hong Kong can be a useful lesson. You see, China can observe how Hong Kong is faring after the reopening. Will this see significant rebounds in cases, in deaths? If there's no significant rebound, probably they can, you know, move forward with the reopening more smoothly, and this could give China more confidence. If Hong Kong can do it, then China can, you know, of course, China can also manage to do the opening.
Eric, thanks so much. Bloomberg economist there, Eric Zhu, on exactly what's going on in China. Now, we keep on monitoring, of course, any headlines coming from the European Parliament in Strasbourg. Just moments ago, Mr. Charles Michel saying that the EU should consider granting asylum to Russian deserters. Now, we'll have a number of other MEP speaking, and of course, we'll see whether the sanctions will bite a little bit more. That is Mr. Borrell just addressing the European Parliament. Coming up, the US and the EU prepare new sanctions on Moscow following the discovery of these alleged civilian murders in Ukrainian towns. We'll speak to Guntram Wolf, director of Bruegel, next. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 juta tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Fed speak sparks a sell-off. L. Brainard sees a speedy reduction in the central bank's balance sheet. The hawkish tone sends global bonds tumbling. The G7 ramps up sanctions on Russia. The EU plans to ban coal imports as the U.S. blocks Russian investments. And we'll get into the fallout from sanctions and look ahead to this Sunday's French election with Guntram Wolff, director of Bruegel. Now, first thing is first, let's also check what the markets are doing. And again, we had a repricing after we heard from L. Brainard sounding a lot more hawkish, saying the bank could shrink the balance sheet at a rapid pace. Now, we saw this global bond sell-off deepening today, stocks wavering on the prospect of this swift reduction in the debt holdings as part of a stepping up campaign of monetary tightening to tackle high inflation. So there is a narrative shift out there that's weighing also on these European stocks, down some 0.1%. In fact, if you listen exactly to what the Fed Governor Brainard said yesterday, she was talking about curbing inflation being paramount. And that once again adds to the central bank idea that it may start trimming the balance sheet rapidly and as rapidly as May. These are some of the sectors on the move. If we break it down, we always look at commodities, especially looking at these extra sanctions on Russia, what it means, for example, for some of the commodity producers, basic resources actually on the way down, but they have been extremely energetic and extremely, of course, really seeing a bid over the last couple of days. Really insurance, media, and food and beverage, the only gaining sectors in today's trading session. On the downside, we have auto parts, basic resources, and technology. So let's now get the latest on the war in Ukraine. The U.S., EU, and G7 are coordinating on a fresh round of sanctions on Moscow following the discovery of civilian murders in Ukrainian towns. Meanwhile, Ukraine's President Volodymyr Zelensky has urged the UN to remove Russia from the Security Council in order to stop it abusing its veto power.
Either remove Russia as the aggressor and a source of the war so it cannot block decisions regarding its own aggression, its own war, and then do everything that we can do to establish peace.
There are live pictures of the European Parliament, this time meeting in Strasbourg. We heard from Mr. Michel, we heard from Mr. Borrell, and now it is the Commission President, Ursula von der Leyen, that's laying out maybe some of the red lines, laying out some of the extra sanctions. And I guess this is also a message not only to the citizens of Europe, to the economists, but especially to Vladimir Putin of Russia. Now, with us to talk more about all of this is Guntram Wolff, director at Bruegel. Guntram, thank you for joining us. I had many questions, first of all, on how much these sanctions are actually biting. I know they hurt the European economy. They're hurting the Russian economy, but they don't seem to be deterring Vladimir Putin in any way, shape, or form. So what is the point? What is the target of these sanctions right now?
Well, I would say the target is really to weaken the Russian economy and weaken the funding possibilities that Vladimir Putin has at his disposal to actually fund the war. And I think what we have to say is that the initial set of sanctions has been impressive, has had a strong impact on the ruble, on the exchange rate, but that the exchange rate has actually recovered. And it has recovered because there's still a lot of revenues coming in from selling oil and gas. I mean, it's really those two that are absolutely critical. Oil and gas revenues amount to something like $1 billion a day for $1 billion US a day for Russia. And that's a lot of money and means that it's so much that actually the exchange rate has been able to recover, and Putin basically still commands a relatively hard currency. So if you really want to sort of weaken the economy, really have a strong impact on Russia, I think we cannot avoid a discussion about how to reduce the revenues that Putin makes out of selling oil and gas.
So, Guntram, if there is some kind of oil embargo, either on the Russian side or on our side, you know, gas, coal, and oil in the next 3 weeks, what happens? So, we know what countries will be hit the most, but is there a plan in place because it's summer, and then does it get tough in winter? How do you model this?
Well, I think the first question is whether a full embargo is really what we need. I think we can really reduce Putin's rent by taxing it away, meaning an import tariff on oil and gas imports from Russia would go a long way of reducing really the extraordinary profits that Putin is making currently. But you are right, even that strategy might fall short because Putin might then decide to actually close the tap. And so we need to be absolutely prepared for the next winter and for a period without oil and gas. And you know what that means is really that we have to allocate the scarce gas quite carefully, and it might be that in the winter, and that's the tough truth here, in the winter some industrial processes might have to close at least temporarily, so that basically households still have gas.
Yeah, and Guntram, what you're talking about is rationing. I think I saw a plan out of Germany on what sectors and what industries would have access first. Why are the other European countries so slow in putting it together?
Well, I mean, I would say Germany is also quite reluctant to really think about this. I mean, they might have put something together, but they resisted very, very much because there's a big fear that this would have dramatic economic consequences. I think the reality is that the economic consequences would lead to a recession. I mean, Europe would slide into a recession, but it wouldn't be a collapse of the entire economy, as some industry lobbyists are now pretending to do. So it's perhaps a decline of GDP in the order of magnitude of 3%, as some estimates suggest. Others say perhaps 5%, but it's not a complete collapse of the economy. So I think we really need to think about this in terms of what are the geopolitical stakes here, and also realize that, you know, if a war continues and drags on, I mean, this, of course, also weighs on economic performance in the medium term. So in my view, we really need to step up the measures, and the measures that were suggested yesterday are not sufficient because they omit oil and gas.
Yeah, and which is why you're talking about a tariff instead of, you know, an infinite embargo, as you put it, Guntram. But the more we see horrific scenes, horrific pictures being broadcast all over the world coming from Ukraine, is an oil embargo really inevitable? If every time there are atrocities, we do sanctions, are we going to end up with an oil embargo no matter what?
Yeah, I mean, I think the end point here is either that the war stops, or really the West, I think, morally will have to stop importing oil and gas altogether, or at least tax 90% of the profits or something of that sort. I mean, I think this will be the minimum, and I think we are really playing a slow catch-up game here. And meanwhile, you know, the atrocities continue. So I think morally, this is going to be absolutely necessary to do.
All right, Guntram, thank you so much. Guntram Wolf, their director at Bruegel, stays with us because coming up, France heads to the polls this weekend at the first stage of its presidential election. We'll discuss more on that with Guntram Wolf about the impact of the war in Ukraine, inflation, of course, how Emmanuel Macron intends to face off against extreme opposition. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
A nuclear plant on the bank of the Seine River, just 70 miles south of Paris. This is one of 56 nuclear reactors in service in France, providing around 70% of the country's electricity needs. That's compared to just 3 reactors left in Germany, whose future is uncertain due to the war in Ukraine. The French energy mix has hardly changed under President Emmanuel Macron, with 2 reactors closing and the launch of the new Flamanville EPR delayed again to next year. For his rivals in the election, he has done too little, too late.
There was this disdain for nuclear for 4.5 years.
Emmanuel Macron's zigzagging energy policy is leading us straight into the wall.
Others, like Marine Le Pen, even talk about dismantling some wind turbines plans.
Wind turbines cost us a fortune. We subsidize them all the time. It's hell. It's a real political, economic, energy and heritage scam.
An influential French climate lobby has recently slammed Macron's green credentials, pointing out that France is also lagging behind in solar and wind power. It's the only EU country that could not reach its target on renewables in 2020. After years of silence on the subject, Macron has announced the building of so-called mini-reactors at the end of last year. Early February, he also said he wants to launch up to 14 new major EPRs, estimated to cost tens of billions of euros.
We need to pick up the thread of the great civil nuclear adventure in France. EDF will build and operate the new EPR reactors. This national company, which is our common good, will be able to count on the support of the state.
The Green candidate, Yannick Jadot, is taking the opposite view. He proposes that France exits nuclear in 20 years.
As we deploy renewable energy and as energy-saving programs take effect, we will shut down the oldest and most dangerous nuclear reactors.
More nuclear or just more renewables, the old debate has re-emerged as a big polarizer in the French presidential campaign. Caroline Conan, Bloomberg News, Paris.
Caroline Conan walking us through France's energy mix and, of course, the future in the wake of the war in Ukraine. Now, this comes as the nation heads to the polls this weekend for the first round of voting in its presidential election. Emmanuel Macron and far-right rival Marine Le Pen are seen as most likely to get into the second round, while the incumbent president is seen beating Le Pen in the runoff with a 54% of the vote in the most recent poll. Now, still with us, Guntram Wolf, director at Bruegel. Guntram, something changed in the polls in the last 4 days, which also led to Eurasia, for example, saying that now the the chance of Marine Le Pen becoming president is at 25% instead of 10% last week. What exactly is happening in these polls?
Yeah, I mean, I have to say the recent change in the polls is really quite dramatic, and it is quite worrying to see that that kind of a change in a situation where the security threat has been so big, and where Emmanuel Macron has actually played quite a big role in trying to solve the security situation. So I think really this is quite a worrying change, and what is behind it is very difficult to say. But my gut feeling would be that the economic situation is becoming tougher. I think people are seeing that prices are really rising, right? And so the middle class really sees how gas becomes more expensive, how energy becomes more expensive, how food becomes more expensive. And these are the kind of signals where people sort of think, well, perhaps it is time to give a warning shot to the top brass, and where perhaps some more of the right-wing ideologies sound more seductive. That's the only explanation I can come up with at this stage.
I mean, it is quite difficult to see. It's very clear that right now, 4 days from the election, Marine Le Pen really holds the momentum going into the first round. If there's a runoff between Marine Le Pen and Emmanuel Macron, can really anything happen on the 24th when we will have a new president?
Well, I mean, look, I would say in general, I think the majority would still vote for. I mean, that's my baseline vote for Macron. So because I think while Marine Le Pen looks more presidential than she used to, she still has a very radical right-wing program, and she wants to undo a lot of things that. Also European integration that I think are absolutely existential and important also to France, including, by the way, issues such as customs she wants to hire additional customs officers to undermine some of the internal market of the European Union. So just to give one example. So I think in the end, my odds are very much still in favor of Macron. But I do have to say it is quite shocking to see how the polls have changed in the last 1 or 2 weeks.
So will it, no matter who becomes president, how will it change France? Are you seeing if Emmanuel Macron gets elected for a second time, will he change his policies because it could be so close?
Well, I think the challenges that Macron has when he gets re-elected is, of course, to address this energy situation, and I think there is really so much that needs to be done there. Getting more independent, making sure from Russian energy imports, strengthening our capacity in Europe to diversify away. I think this is really going to be one of the key challenges. And then, of course, he has to think about how does he help those most affected by this energy and food price increase. So this could be, for example, additional support programs for the middle class, or at least for the poor in the economy. But I think the big challenge will be how to do all of this at a time where French debt has already become quite high, and he will have to start the fiscal consolidation process in the coming years. And that's never popular, and in France it's particularly unpopular. So it's not really going to be an easy ride once he comes in. Fiscal challenges on the one hand, rising prices on the other hand, pressure on the middle class. So how he's going to square the circle, I think people will realize that this has become a difficult situation.
Guntram, thank you so much. Guntram, author, director at Bruegel. Now we'll have plenty more, of course, on France throughout the day. Also coming up, James Reid, chairman of a major UK employment agency on the UK jobs market. That interview up next. This is Bloomberg.
falling energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open, everyone. 51 minutes into the European trading day. This is a picture for equities. We are seeing global bond sell-off deepening, stocks wavering on the prospect of a swift reduction in the Fed's, of course, debt holdings. This is after we spoke to Lael Brainard, or at least Lael Brainard gave a speech yesterday. Now, last month, UK unemployment dropped below its pre-pandemic level for the first time as companies generated more jobs and granted higher wages than expected. However, analysts are also warning that inflation and cost of living pressures are negatively impacting the UK jobs market. Well, joining us now is James Reid, chairman of the major British employment agency, Reid. So thank you so much, Mr. Reid, for joining us. I have a lot of questions about inflation, wage growth, shortages, and what you're seeing overall. First of all, how would you describe this jobs market? Are a lot of people resigning? Are we living through the Great Resignation?
There's a jobs boom going on at the moment, Francine, and it started a year ago, and it's still continuing. I keep asking myself, are we peaking, or has it peaked? But it's still continuing, and we're seeing 13% month-on-month growth for jobs. So there are masses of new jobs coming onto the labour market, but there are real shortages of people, and we're seeing that affecting a lot of aspects of the economy now. We've just heard about the situation in Manchester Airport, where there's been huge queues because people can't get through security, and lots of businesses are struggling to hire. What are they doing? They're putting wages up.
Yeah, so this is real. You can see in negotiations, is it like a 5-10% increase? And of course, that will be inflationary overall.
Well, we've seen quite a lot of spot price increases, I suppose, if you call it. I wouldn't say it's general, but we're seeing a lot of companies often paying premiums of 20, 30, 40% to attract people. So where you've got a company that's eager to find people, they have to pay a premium to get people to move. And that's where we're seeing the increases. So particularly in areas where skills are scarce and where there's great demand. Yeah. So that's happening. But then there are other parts of the economy where it's really lagging. So a lot of people are not getting pay increases, and they are being squeezed by inflation, and they're really hurting.
So where are you seeing the most staff shortages? And I don't know whether it's Brexit related or it's just people having left the workforce after the pandemic. Is there a sector that feels particularly hot right now?
Well, the whole economy is really hot, but the hottest areas are technology and also education. And we're getting calls for teachers because a lot of teachers are off with the virus still, and we're struggling to fill all those requests. So the education sector's really pushed, but technology is and continues to be the hardest to source.
Are you expecting unemployment to pick up later this year when you have a cost of living squeeze because of Ukraine?
Well, at the moment, unemployment's at pre-pandemic lows,
which is amazing.
And so, yeah, quite. But there are two sides to this story because also inactivity in the workforce has increased. So there's 400,000 more people economically inactive, and there are 8.8 million people in the UK economically inactive. That's a huge number, and I think that the task now is to encourage or help some of those people back into work because that will ease the pressure on all these organisations that are struggling to recruit.
So, I mean, you mentioned Manchester Airport. How are you struggling, to fill some of the vacancies, for example, in some of these airports? If people are off with COVID, like, what's the right way of looking at this?
Well, we don't specifically work with Manchester Airport, but I can feel the pain of that situation because it takes a long time to train people. So if lots of people are suddenly unavailable for work, and you have to train people to run these systems safely and securely, you're going to be caught in a hard place, and that's likely to last for some time. But that's happening in a lot of different businesses at the moment, and it's limiting growth, and I think we'll start to feel that later in the year.
So what's the right way, again, to I guess, tide over these shortages?
Well, if you're an employer?
If you're an employer, or if, they come to you for services?
Well, I think if you're an employer, you want to really look after your existing staff, so you should make sure they're fairly paid. And if you're seeking to attract people, you do need to pay a premium, because that will get people to move jobs. Because a lot of people who are being squeezed, who are finding the cost of living crisis is hurting them, will be looking to earn more money. And an obvious way of doing that is go and find another job.
Yeah, what about someone who, wants to do better? So maybe in a lower paid job where inflation isn't being able to catch up with the cost of living. Like, what's the right business to go into right now?
Well, there are lots of, we're carrying record vacancies on our website, so over 300,000 live jobs. So go and have a look would be the first thing. So there are a lot of opportunities out there. So if you're looking for a job, this is a great time, best time in 50 years to be looking for a job, because there are so many and the pay is going up. Whether it will keep up with inflation for everyone, well, that's an open question.
All right, James Reid, thank you so much for joining us today. That was the Reid chairman joining us, of course, on UK employment. Now, that's it for the European Market Open. Surveillance Early Edition is up next. We'll have a full roundup of what's going on with bonds and stocks. Global bond sell-off deepening today. Stocks wavering on the prospect of the swift reduction in the Fed's debt holdings as part of a stepping up campaign of monetary tightening to tackle higher inflation. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
the balance sheet to shrink considerably more rapidly than in the previous recovery.
I think 50 basis points is going to be an option.
Remove Russia as the aggressor and a source of the war so it cannot block decisions regarding its own aggression.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, and this is what's coming up on today's program. Brainard the Hawk, the Fed governor, backs a speedy reduction in the central bank's balance sheet. Global bonds are sent tumbling. Zelensky tells the UN that Russia's abusing its veto powers. The U.S. and its allies will announce fresh sanctions on Moscow. And stay with Bloomberg Surveillance Early Edition. This hour, a little bit later, we'll have an in-depth conversation about energy markets and commodities with Jeff Curry from Goldman Sachs on our very own Javier Blas. You can send in your questions and analysis on IB Plus TV Go. You can also tweet me directly. Now, this is a picture for the markets. So we've seen a pretty brisk move when it comes to a lot of these bonds and stocks, given what we heard from Lael Brainard. The European stock 600 down some 0.9%. Again, a lot of the stocks are wavering on the prospect, as we were just saying about the Fed's debt holdings being reduced earlier than expected. And this would be, of course, part of a wider stepping up of a campaign of monetary tightening to tackle high inflation. So you see a repricing on some of the bonds. Again, when do they start being attractive enough so that we also see a rotation away from European stocks into bonds? Currently, the U.S. 10-year yield at 2.6069, and that U.S. dollar index, Bloomberg one 202. Now, if you delve a little bit deeper into the various European indices, now, of course, if you're the UK and the FTSE, you are extremely commodity rich. We did see a bounce back yesterday as commodities on the way up because of oil. Today, they're down some 0.4%. Bigger loss, for example, for the DAX, that's down 1.1%. Now, ahead of the FOMC minutes being released later this week, Lael Brainard said the Fed will start reducing its $9 trillion balance sheet at a rapid pace as soon as next month.
Given that the recovery has been considerably stronger and faster than in the previous cycle, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps compared with 2017 to 19.
Now we're joined by Nigel Bolton, Co-Chief Investment Officer at BlackRock Fundamental Equities. Nigel, thank you so much for joining us. I don't know whether there's, a repricing on the stock market because we didn't think about, of course, the balance sheet as much as we thought in terms of a tool for readjusting, or whether there's simply a fact that now the market thinks that the Fed is very, very aggressive in dealing with inflation, almost at the expense of growth.
Well, we always thought that this year was going to be a challenging year for equity markets. We thought there was going to be more volatility. History shows us that as we go into these periods, where we're moving into a tightening phase, that the market has to adjust. And that's indeed what we've been seeing. You then throw into that a war in Ukraine, and you've got all the recipes there for really quite a significant correction in markets. And I think that's what we've really seen over the last couple of months or so, where the markets have been adjusting to that. We had more news overnight from Brainard in terms of maybe the speed and the scope of the tightening. And this is a problem for investors globally because we are in kind of slightly uncharted waters here. We haven't really been at this phase where we're getting to the proper tightening, the removal properly of QE, moving into that QT phase. Yes, we've always had rate cycles in the past, but this is an extra problem that investors are having to grapple with. So from our perspective, certainly from an equity markets, we're very much looking for resilience, companies that are resilient to this type of environment. And I think the growing risk as we move towards 2023 and into 24 of a recession. It's something that we talked about at the beginning of the year. The probability of that has risen, and that's what you're starting to see now impacting risk assets around the world.
Okay, so first of all, what kind of recession, and what does that mean for capital? I know you think capital's at risk. What does it mean for investment strategy then?
So I think what you have to really go towards quality. That is companies that have got strong balance sheets, companies that actually have got good business models that can prosper and do well in a more volatile environment. And I think the extra complication when we talk about recession is, are we talking about a GDP, a real GDP recession, or are we talking about a nominal GDP recession? I think the chances of a real GDP recession have significantly increased, but actually nominal GDP is likely to remain quite positive because this inflationary pressure that we've seen coming through is likely to last for longer. And that means there are going to be some winners as well as losers in the equity market. So you're going to get some real differentiation. Who can actually win in that higher inflation environment, even in the face of a kind of a real GDP recession?
And so, which means what? Are you adding to quality growth? Is it value stocks, or are you looking for just cheap things?
So look, I think you have to be more diversified than the last few years where it's been very much about growth. I think you want to avoid high-rated stocks. You want to avoid those where the value is based on a lot of future growth, because that is going to become more uncertain. So companies that can deliver you earnings, cash flow, and dividends today and have the ability to grow that. So which sectors are we thinking about here? You know, I think the energy sector looks really interesting. I think the fundamentals have changed there, both in terms of renewables, but also in terms of more traditional energy markets. I think if you look at the industrial sector, historically, you might say not an area you want to go into in terms of a recession, but actually within that, there are a lot of winners going on there, particularly when you look at the sustainability here within Europe, the move towards reducing energy costs. So companies involved in insulation, companies involved in heat pumps, for example, those type of businesses are actually going to do well in this environment.
Yeah, I mean, on energy, I mean, there's a million questions on first of all, if you invest now, and I know we've gone back to fossil fuels, but by the time there's investment in there, of course, as a market participant, we could be at the end of the phase of fossil fuels. So there's always a problem of timeline. And of course, when it comes to renewables, we're extremely dependent on some of the raw materials going in Ukraine that are needed, that maybe the market is discounting, that are needed to make up for the transition. So how will this all play out?
You're absolutely right, and these are the complications. It's why you have to be very specific about the stocks that you're actually going to be investing in this environment. You have to understand their supply chains. Yes, there are definitely areas where the supply chain has been disrupted because of Ukraine. Now, markets, and businesses will flex and will find new sources. So it's understanding those companies that can win in that environment where there are disruptions to supply chains. Understanding the company's business model is going to be really important going forward.
Nigel, when you look at some of the quality companies, do you worry about the next earnings season, that actually there's something uglier happening there?
I do worry about the next earnings season. I think as we look at expectations for consensus earnings this year, it's about 9.5% for global. It's about 8% here in Europe. I do think that those numbers are going to come down this year. It's why you need to be finding companies that are going to be more resilient, that actually are going to be able to cope with supply chain disruptions, cost price inflation, and being able to maintain some growth within there as well. So I suspect that 9% global EPS number is probably going to be coming down more into the kind of 5 region as we get towards the Q4 this year.
Nigel, thank you so much. Nigel Bolton, their co-chief investment officer at BlackRock Fundamental Equities, joining us this morning. Now, Esther George says a half-point rate hike might be an option at the Fed's May meeting. The Kansas City Fed president also said that current economic conditions support removing monetary accommodation at a faster pace than previous cycles. Well, George spoke exclusively to Bloomberg's Michael Mickey.
We've got short-term policy rates, and we have a very large balance sheet that are affecting the amount of accommodation in the economy. So it will take thinking about both of those things, I think, as we come to our May meeting to decide what is the appropriate pace, what's the appropriate amount of a policy decision at that meeting.
Well, there are a lot of people on Wall Street who say the Fed's behind the curve and you've got to go 50 because you're going to lose control of inflation if you don't.
So we know that this policy is as accommodative as at any time when we have inflation this high, when we have labor markets this tight. So there's no question that policy has to be removed. But I think you have to do that in the context of having highly negative real rates, a $9 trillion balance sheet, and thinking about how that combination is going to flow through to the economy. So yes, we have to be very deliberate and intentional as we remove this accommodation.
Well, let me rephrase the first question. Would you support 50 if that's what the majority wants to do?
I think 50 basis points is going to be an option that we'll have to consider along with other things. And again, I'm very focused on thinking about how the balance sheet moves in conjunction with policy rate increases.
Well, let's talk about that. Lael Brainard, who's in line to be vice chair of the Fed, said this morning that she expects the balance sheet to shrink more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps. Does that summarize where the Fed is going?
So I think when you compare this cycle to where we were the last time, we were reducing the balance sheet, and we didn't go very far because of the need for reserves and the decision around that. When you look today at where the balance sheet is and the conditions in which we'll be doing that, I think it easily argues for going faster and moving along at a quicker pace than we did before. We have a ways to go to get this accommodation out of the economy.
Monthly caps of $100 billion sound realistic?
So I think we're still talking about what the right approach would be relative to last time. And again, we're doing that in the context of looking at the size of the balance sheet and the conditions in the economy today, which will likely warrant doing more and going faster than before.
What's your anticipated impact of reducing the balance sheet in terms of a rough equivalent to basis points in a rate move?
So I think it's an important question because we often focus so much on the benefits going in terms of how it pulls duration out of the market, it boosts asset values. I've been looking at some of the estimates that go all the way to 150 basis points effect of that balance sheet on longer term rates. So wherever that is, I think there is clearly going to be some adjustment that takes place, both in asset markets as well as long-term rates. And I think when I look at the yield curve, I'm looking at that issue relative to that balance sheet and what effect it's having on longer-term rates, less so around some of the conversation on whether it's predicting a recession.
Well, that was the Kansas Fed President Esther George speaking exclusively to our Michael McKee. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we'll also have an in-depth conversation about energy markets and commodities with Jeff Curry from Goldman Sachs and our very own Javier Blas. Send in your questions on IB Plus TV Go. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Either remove Russia as the aggressor and a source of the war so it cannot block decisions regarding its own aggression, its own war, and then do everything that we can do to establish peace.
As the Ukrainian President Volodymyr Zelensky speaking at the UN yesterday. Now let's get the latest on the war in Ukraine. The US, the EU and the G7 are coordinating on a fresh round of sanctions on Moscow following the discovery of civilian murders in Ukrainian towns. So joining us now is Bloomberg's Europe correspondent Maria Tadeo. Maria, good morning. So what is this actually in the sanctions package, and what concrete impact, if any, will it have?
Well, Francine, they're hoping that this will really turn on the heat on the Russian industry, but also in particular when you look at hydrocarbons. This is really the moneymaker for the Russian Federation at this point. And there is a realization, particularly here in Europe, that in many ways, if you strip away the jargon, we are sending money to Russia. And all of this is, of course, paying for that war machine that has unleashed or has been unleashed on Ukraine. Now, today we are expecting, as you said, the fifth package to be approved by European officials. We know that it will target coal buyers. Will have 3 months to pull out of these contracts. They won't be allowed to sign new ones. But the biggest question mark is what happens with oil, that is seen as a moneymaker, and gas, which is also seen as a geopolitical weapon of Vladimir Putin when it comes to blackmail. Today, we did hear from two very senior European officials, the head of the Commission, but also the head of the European Council, say it openly. There will be a debate around oil. And then when it comes to cashing those payments to the Russian Federation, Francine, there's also increasing debate about setting up something that looks like an escrow account so that Europe has more money and more power over where the funding is going and what the funding is used for. But again, all of this is still early days and certainly won't be approved today.
Maria, President Zelensky accusing Russia of committing unspeakable atrocities. In this context, how can peace talks between the two countries continue?
Yeah, and Francine, they were supposed to continue. We were expecting actually a video conference this week, but yesterday you heard from President Zelensky. He was furious at the United Nations, saying there is no point being here if you don't kick Russia out. Russia, in the same time, same place, continued to deny everything, saying the pictures are fake. This is an Anglo-Saxon media campaign. But for the time being, those talks allegedly would continue. But Francine, when you look at the situation on the ground, we know the fighting continues. We know the Ukrainian army is now preparing itself for a major offensive in the Donbass. And of course, we've seen that we're nowhere near a ceasefire.
All right, Maria Tadeo there in Brussels for us. Thank you so much for joining us. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we'll also have an in-depth conversation about energy markets, oil and commodities with Jeff Curry from Goldman Sachs and our very own opinion columnist, Javier Blas. You can send in your questions on IB plus TV Go. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, NATO foreign ministers are meeting in Brussels. That's as the US and EU are considering a new round of sanctions to punish the Kremlin over its alleged actions in Ukraine. Meanwhile, opinion polls in France, a key EU, G7 and NATO ally, suggest a close race in Sunday's presidential polls. So there is definitely a lot to talk about. We're joined by Lindsay Newman from S&P Global. Lindsay, thank you for joining us. I have a lot of questions first about the sanctions, the extra sanctions that the U.S. is putting in place and the EU. If the idea is actually trying to deter Vladimir Putin from continuing its campaign of fear in Ukraine and killing civilians, it hasn't dented him at all. So what will work, if anything?
Well, what we've seen so far, as you say, is there's been a whole host of sanctions imposed across individuals, banks, financial institutions, and then, of course, a wave of corporate self-sanctioning that follow those steps by the U.S. and Europe and their allies. They've been effective in isolating Russia from the global economy. They've been effective in changing the sort of economic picture for Russia. So we are, in fact, forecasting an 11% contraction for Russian GDP for this year alone, and a further 4% contraction for 2023. Again, this is all from a self-created crisis by invading Ukraine on 24 Feb. But where they haven't been as effective, as you say, is actually halting what we're seeing on the ground in Ukraine. And in fact, as President Zelensky very clearly stated yesterday before the UN, there is, this massive humanitarian toll that we're seeing, these potential allegations of potential war crime activities that's being investigated. We did see overnight the U.S. took action to block Russian access to dollars held in U.S. banks to prevent them using that for bond payments. And that's something we've been watching, how Russia has been servicing its debt, but its ability to continue to avoid defaults in the longer term.
So, Lindsay, we just have a brilliant opinion piece by our Javier Blas saying, look, it's entitled Europe's hypocritical gas policy is not sustainable. And he argues in this piece that the EU cannot keep funding Russia's war by paying for energy supplies. If there was to be a full oil and gas embargo from Europe to Russia, does it change the course of the war?
So that is exactly what's being contemplated today. As we've already heard earlier in the program, for the first time, the EU is considering putting a ban on coal, as well as other energy assets or other energy supply coming from Russia. And in fact, we see President Macron even coming out and joining public calls for these bans on coal and even other energy supplies as he faces this critical election this weekend. But should this happen, we know this is a massive source of income that's sustaining Russia's ability for the war efforts, as well as for, as I've already said, servicing the debt. So it has the potential to be a game changer, but we will have to watch and see if this actually does go ahead and how comprehensively it goes ahead.
Lindsay, give us a sense of exactly what the next step is in this war and what it means for the European economy. Are governments rich enough to be able to put fiscal policies in place to shield, the people from a rising cost of living that makes the situation unsustainable?
Well, as you say, we're about 6 weeks into this conflict, and what we're seeing in the conflict itself is two key shifts that I would highlight. The first is around aim and objective, and the second one is around timeline. And these play into your questions because, as National Security Advisor Jake Sullivan said yesterday, we are seeing a shift in Russian objective, a shift in Russian aim here. They're pulling out of Kiev. The focus really is on the south and east with redeployments for the Donbass region. We think, though, that we're going to continue to see activities like the aerial bombardments we saw overnight into central Ukraine, where the target there is really these key infrastructure components like oil depots that were hit overnight, like food supply sources. And we have to remember that Ukraine and Russia separately are, while they make up a small component of the global world economy, For Russia, it's something like 1.8%, and for 1.1%, and for Ukraine, it's under 1%.
Right.
They actually are huge suppliers to these two European markets, as well as far afield with China and elsewhere in the Middle East, of key commodities like food supplies, grain, corn, fertilizer, and minerals. So that's going to hit home for all of these European economies.
Lindsay, thank you so much. Lindsay Newman, Director of Economics and Country Risk at S&P Global. Smart Conversations continue right here on Bloomberg Surveillance Early Edition. Up next, we'll have an in-depth conversation about energy markets and commodities with Jeffrey Curry from Goldman Sachs and our very own opinion columnist, Javier Blas. You can send in your questions on IB Plus TV Go. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Brainard, the hawk, the Fed governor backs a speedy reduction in the central bank's balance sheet. Global bonds are sent tumbling. Zelensky tells the UN Russia is abusing its veto powers. The U.S. and its allies will announce fresh sanctions on Moscow. And coming up next, an in-depth conversation from energy markets and commodities with our Jeff Curry from Goldman Sachs and our very own Javier Blas from Bloomberg Opinion. You can send in your questions on IB Plus TV Go. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. This is the picture for the markets. Quite a lot going on in the markets, both on the stock side, but also on the bonds. If you look at a gauge of global bonds dropping below this key fixed income watermark after the Fed Governor, Lael Brainard, signaled a quicker than expected rundown of the central bank's debt holdings. Now, I can see the picture for the S&P futures also down some 0.4%. Of course, the picture is what this means for anything in terms of earnings, in terms of inventories going forward, stocks sinking after we heard that hawkish Fed. Now, the US, European Union, and the G7 are coordinating on a fresh round of sanctions on Moscow. This would include an EU ban on coal imports following the discovery of civilian murders in Ukrainian towns abandoned by retreating Russian forces. Our European Council President Charles Michel also told MEPs this morning that the EU must impose those sanctions on Moscow in the near future.
The new package includes a ban on coal import. I think that measures on oil and even gas will also be needed sooner or later.
Let's get straight to Jeff Curry, Global Head of Commodities at Goldman Sachs. Jeff, thank you for making the time to come on Bloomberg. I have, first of all, a million questions about an oil embargo. If tomorrow, in 3 weeks, there's an oil embargo between Russia and Europe, what happens?
Obviously, make prices go up. Why? Because you have to redistribute oil around the world. So you're going to get a bid in local barrels, particularly in the Western Hemisphere, and obviously Brent barrels, West African barrels to try to replace those Russian barrels. But the question then becomes, what happens to the Russian barrels? They get traded at a steep discount. We'll likely see if somebody like the Indians or the Chinese pick it up. But I think the key point here that people seem to forget is you need the Middle East and OPEC to agree to this, because you're going to basically have to crowd out their market share in places like China and India to replace those barrels in Europe, which I think will be a tall order to ask. So it's not easy.
But Jeff, so first of all, we know that there have been conversations, I guess, behind closed doors. How likely is it that this happens? How likely is it that we can deal with an oil embargo, even if the weather in Europe is not that good?
I think it'd be very difficult, which is why, they started with coal. Coal is the easiest. You can think about it on a scale of fungibility. Coal is the most fungible, gas is the least fungible, oil is somewhere in between. Coal is the one you just put it on ships, move it around the world, and it's relatively easy to reshuffle or redistribute around the world. Oil becomes a lot more difficult because it's more sophisticated pipelines, refineries, and things of that nature. And then gas is, I would say pretty close to impossible to do, which means gas would be the very last energy that they would potentially boycott. But oil, it'll be very, very difficult to do as well. So we'll see what happens. I think, they've already showed their hand, which is why they chose coal to begin with, because it's the most fungible.
Jeff, you have retreated a little bit on the oil price forecast since, the strategic releases. Where are you now? And again, do you see the wider commodity complex under a lot more pressure than we have seen in the past?
Absolutely. We're still bullish on oil post the SPR announcement. We see oil, trading up to $125 a barrel. I want to emphasize that what this ultimately does is it crowds out more investment. It makes this long-term situation worse, because SPR release is not a long-term solution to underinvestment. As we like to emphasize, it's not about the supply and demand of the barrels of oil or metric tons of copper. It's about the supply and demand of the dollars used to produce those barrels of oil or metric tons of copper. And that's where the shortage is. Whether if it's ESG policies around the world creating a huge capital deficit, or bank lending leverage ratios that is restricting bank lending credit to the industry. Let's think about this. Oil prices are 2 times higher than what they were a year ago. That means working capital requirements are 2 times higher.
Jeff, I also need to bring this to your attention. So traders are now betting on the Fed raising interest rates 225 basis points by the end of the year. This is after Lael Brainard, of course, sounded a lot more hawkish. The linkage between this dollar and oil is also very clear. Our Javier Blas from Bloomberg Opinion just sat down. Jeff, I annoy you and him almost every day trying to figure out what happens next with the price of oil. And one thing that I was chatting with Javier, and I'll bring him in a second, is how easy is it to actually divert some of the supply? So you're Russia, you're saying you're thinking, right, either there's an oil embargo from the European side or I'm going to do it. What kind of negotiations are ongoing? Because the pipelines are not necessarily there to divert all of this stuff to India and other countries east.
Extremely difficult to divert. Not only do you run into transportation issues, also long-term contracts of existing flow of oil to refineries around the world, but also the quality really matters. You just can't take any oil anywhere in the world and shove it into a refinery. There's light oil, there's heavy oil, there's sour oil, there's sweet oil. All of that really matters. So it's a very difficult time, expensive, and it's definitely not frictionless process.
All right, we'll have plenty more, of course, on the price of oil and other commodities. Jeff Curry, Global Head of Commodities at Goldman Sachs. Up next, also Bloomberg Opinion's Javier Blas gracing the floor. I haven't seen him for a while, so I'm also excited to speak to him here in the studio. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrits. Hi, Leanne.
Hi, Francine. China's services sector took a massive knock in March. The Caixin Services PMI tumbled to 42 in March from just above 50 in February, the lowest level since the depths of the initial lockdown in early 2020. The reading was well below the 49.7 estimated by economists. The latest holiday spending figures suggest there's more damage to come this month. Now, the US, UK and Australia say they're working on developing hypersonic weapons as part of their trilateral security pact, AUKUS. The partners will also look to deepen defense cooperation in areas such as electronic warfare and artificial intelligence. Hypersonic weapons technology has already been deployed by Russia in Ukraine. And London's investment banks are struggling to shrink the gender pay gap, with women making up less than a fifth of the top earners. According to the latest UK government data, just 15.5% of the top quarter of earners were female across a sample of 10 securities units in the City of London, up only slightly from the previous year. That proportion is worse than the 20.5 across broader finance industries. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrits. This is Bloomberg. Francine.
Leanne, thanks so much. A little bit later on, we'll speak to Olivier Blanchard, the former IMF chief economist. That's at 8:45 a.m. New York time, 1:45 p.m. UK. But coming up, an interesting, important conversation with Jeff Curry of Goldman Sachs and Javier Blas. We'll talk oil, commodities. Maybe we'll also get a question or two about nickel. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now we're back with Jeff Curry, Global Head of Commodities at Goldman Sachs, and Bloomberg Opinion's Javier Blas also joins us. Now, this morning, Javier has also written a column entitled Europe's Hypocritical Gas Policy is Not Sustainable. In it, he argues that the EU cannot keep funding Russia's war by paying for energy supplies. Jeff Curry also has a wonderful new note out talking about a financially constrained physical market. So thank you both for either sticking around or joining us. First of all, Javier, when it comes to supply, I mean, I know you're baffled at the price of oil. Talk to us a little bit about the dynamics that means that you think it should be higher.
I'm surprised that we are only at $110. I know that there are some factors that they're pushing prices down, including the release of the strategic petroleum reserves that Jeff was mentioning earlier. But if you look at the physical market, we are facing a shortage. And the market itself is shorter than it looks like because some of the Russian oil is flowing into the market. The traders are fulfilling the long-term contracts. They're buying that crude. But that crude is not going to any refinery. In a market that is extremely short, in a market that is massively backwardated, in a market that every barrel should be consumed, we are putting Russian barrels into a storage because no one wants to buy. And that at one point, we are going to just have to go higher.
Yeah, and Jeff, this is also, someone's writing in, a viewer, thank you so much for all of the viewer comments, but, this person wrote at length, basically saying, where is the supply constraint? If you look at Venezuela oil, if you look at, Iran will be soon back on the markets, if you look at some of the other things, like, is there a supply problem right now for oil?
Absolutely, yes. And this goes back to 2014. Overall CapEx is down 35%, yet demand is higher. If you look at every producer, with the exception of UAE and Saudi Arabia, are producing less today than they were in January 2020. So when we think about these supply constraints, they're broad-based. And particularly, you think about non-core OPEC, places in Africa like Angola or Nigeria, because it's deep-water offshore platforms and the concerns around decarbonization, we've seen no money go into those parts of the oil complex. And as a result, the supply constraints are severe. Throw on the Russian shock on top of it. The supply constraints are, the biggest we have seen in decades, since the 1970s. So, no, this is a real shortage. Hence why the Americans just, had a record SPR release that is still insufficient to be able to deal with the scale of the problem.
And this is despite, Javier, China also being in semi-lockdown. So how do you model an oil embargo and the impact? Like, what are the flows to and from Russia and into Europe?
Well, Russia exports about 8 million barrels a day of crude and refined products. If we lose a significant chunk of that, at some point we are gonna lose that. There is no replacement. China and India can buy a fraction of that, but they will hit logistical limits that Jeff was talking about. I mean, there are so many tankers that you could use. There is no extra pipeline capacity into China. There is no pipeline capacity into India. There is simply not pipeline. Everything has to be done by tanker. So we will suffer a significant reduction in supply, and on a market that is already very tight and with very limited inventories to start with. This is not a comfortable situation that we started with. We started with a market that it was tight or very tight, and we are going in a massively tight market. And one very important thing, we are just emerging from the lowest point of the year in terms of oil demand. Yes. Traditionally, the end of March, beginning of April, is when all the refineries are doing seasonal maintenance to prepare for the summer demand. From here all the way to the middle of August is incremental demand. And we are already $110, and we are struggling to supply the market. What is going to happen in June and July when all of us are going on holiday?
But, Jeff, that's a floodgates for stockpiles, right, to be released. I mean, we keep on hearing Fatih Birol. They have the stockpiles. I mean, how much can they help in supporting this?
Well, I think when you look at where they are, and the big stockpiles are in the U.S. So the question is, who's going to request to take those barrels out of storage? We'll find out. The release they did back in November, only a third of the barrels were actually taken because they actually, ultimately they're a swap. They're going to be bought back at some other point in time by the U.S. government. And I think the key point is the logistics to get those barrels to the refineries that can process them. It's kind of that same problem we were talking about before, is not all oil is created equally, nor are all refineries created equally. And the one thing we haven't talked about yet this morning really is what's going on the product side. Products are extremely tight. That's where the shortage is. It's developed, particularly jet fuel and distillate right now.
There's also that's an extremely good point. We also have another viewer, Javier, saying, Russian oil exports are de facto under sanctions. So what would be the real impact on Russian oil exports if Europe were to sanction its oil? Gas, of course, being another story.
Well, there is self-sanctioning, but some of that oil is still flowing. We have not seen yet a significant reduction in Russian oil exports. We have seen some reduction, but not a significant one. So if real sanctions were put there, we can lose half of the production of Russia. That will create a 4 million barrel a day hole into the market that it will be very difficult to replace. And to Jeff's point, Russia not only export crude, they export a lot of refined product and semi-refined product that we need, and that's potentially the biggest problem. Diesel and jet fuel are in short supply. Jet fuel earlier this week went up to the equivalent of more than $300 per barrel in New York Harbor. That is what supplies all the New York airports. That is much, much higher than it went in 2008. So that's a big, big problem.
Jeff, what part of the commodity complex do you most worry about? So in this brilliant note that you put out, you talk about a financially constrained physical market. I mean, we talk, almost day in, day out about a possible big margin call. Like, is something in the commodity complex going to go wrong? And if so, could it happen quite quickly?
The one that is in the worst shape in terms of tight fundamentals are the grains. The shock coming out of Ukraine on wheat. 25% of the world's exports. You're unlikely going to get the planting season in Ukraine this year, which will leave you really tight going into the new crop next year. So that's the one that's potentially the most explosive, and also it's the one that has the biggest impact on potential social civil unrest in places, particularly like North Africa. But beyond that, oil is the one we're watching. I think I agree with Javier. It's startling that oil is only trading $110 a barrel right now, given the fundamental backdrop. And it's the one that's being the most severely impacted by this underinvestment, as well as liquidity issues.
Jeff is right, highlighting food, because that is where potentially is the biggest political implication. Energy matters. Energy is important for the industry, but food prices in emerging countries, North Africa, West Africa, Southeast Asia, the only thing that is keeping those areas from serious civil unrest is that the fact that the price of rice remains under control. It has not gone up as much as wheat and other ones, but vegetable oil, we are going to face shortages. I mean, in many countries already in Europe, you go to the supermarket and you cannot buy more than X number of bottles of vegetable oil, particularly sunflower oil. That is going to come, and it's going to become more widespread as the months go. We're going to have all to go to default to olive oil, Francine.
I mean, being Italian, I'm not against it, but we did have the Colonel chief executive yesterday, and they, of course, make, I think, 50%. Ukraine makes 50% of global sunflower oil, and they're the biggest producer there, and the picture is not very good. Going to nickel, I know we've been writing about nickel nonstop. Jeff, when you look at the nickel market, and frankly, the nickel chaos, does that put, the London Metal Exchange at risk of what it can do? Like, how much pressure is it putting on the LME?
Well, I mean, there was specific issues tied to this in the sense that, you had groups that were basically long the Shanghai exchange and short the LME, and there was, you basically had limits on how fast the Shanghai could go up, and you basically created a margin call on the LME that couldn't be met from profits out of the Shanghai. So let's take that out, but it illustrates a much bigger problem here, which is the access to liquidity. It's not isolated to metals or nickel. You think this goes to this point. Look how high commodity prices are today versus where they were, a year ago, 2x. And as a result, the overall capital needed to fund these positions is far greater, and the access to that capital is not there due to, Dodd-Frank type of regulations going back, nearly a decade ago that restrict leverage of banks, that do not allow the increase in capital that's sufficient enough to meet this. So this is a serious problem, and it's not isolated to nickel or the LME.
So this doesn't put the LME more in a spotlight than other. I mean, it does, but it doesn't put its future at risk.
It definitely puts the LME more in the spotlight. But I think the key point here, and this happens at every bull market I've ever been through, is what happens is as the prices go higher and higher and higher, the producers who have sold forward get hit with margin calls. They buy back those positions that drives the market higher and higher as you go through this dynamic. But what's making this one far worse than anything I've ever seen before in creating a volatility trap is that the lack of liquidity. The lack of liquidity forces either more buying, more selling, which then drives up the higher volatility that then discourages more liquidity. The banks don't want to give any funding to this market with that type of volatility. Neither do investors. I like to say the market may be long on conviction, but it's short on position due to these financial constraints.
All right, so thank you both for joining us. A very robust conversation. Jeff Curry, their Global Head of Commodities at Goldman Sachs, joining us, and also thanks to Javier Blas from Bloomberg Opinion. Now, coming up, Elon Musk joins Twitter's board. We dive into the details of this move and what it means for social media companies in general. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Twitter has named Elon Musk to its board. Everyone's talking about this. This comes a day after it was disclosed that Musk is Twitter's biggest shareholder. Well, joining us now is Bloomberg's Quick Takes, Alex Webb, who, of course, is in charge of all of our technology coverage. Now, first of all, Alex, I mean, this is an amazing story. Why is Elon Musk getting, what exactly is he getting for his money? How much influence will he have on the company, and how big of a financial commitment is it?
So for him, it's not a massive financial commitment. Right. It's probably about $2.5 billion is how much it costs to get this 9.2% stake, whatever it is. That's less than 1% of his net worth. Now, what he's getting for it, influence. If you look at the way that Twitter's been affected over the past 2 years by its activist investor, Elliott Advisors, which is Paul Singer's activist fund. They had less than half of Elon's stake. They got a board seat. Within 18 months, 2 years, the CEO, Jack Dorsey, was out the door. So, you know, Elon could possibly have looked at that and gone, for not a huge amount of capital on my part, I can get a huge amount of influence over a company that is, for me, super important. Because if you look in Tesla's SEC filings, it says in those, Elon's ability to generate earned media is really important to us.
Yeah, so I was going to say, I mean, is this like a financial investment? Is this like, in the context of Tesla, is this, you know, about money, or is this like you and I going to, I don't know, sewing and buying a PlayStation?
I mean, I think it's better to think about it in terms of billionaires buying newspapers, right? When they buy newspapers, they're not necessarily doing it to make money out of it, but it is an influence play. Now, we don't know for sure. Guessing exactly what Elon's up to is a bit of a mug's game. But he has the ability here to control his voice and sense.
Well, there you go. This is another meme request for Elon Musk to come and speak to Bloomberg Surveillance Early Edition. Alex Webb, thank you from Bloomberg. Quick Take, the Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Katie Lyons in New York, Guy Johnson here in London. We'll have a full roundup of what we heard from Fed Governor Lael Brainard. This is Bloomberg.
Nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor, y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The Fed now has to come out guns blazing, concerned that the Fed is going to keep hiking.
It does appear as if the central bank is willing to sacrifice growth.
I expect the balance sheet to shrink considerably more rapidly than in the previous recovery.
I think 50 basis points is going to be an option.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, it's 5 a.m. in New York, it is 5 p.m. in Hong Kong on this Wednesday, April the 6th. These are our top stories. Ahead of today's FOMC minutes, traders are now pricing in 225 basis points of hikes from the Fed this year. On top of that, as we just heard, Lael Brainard is warning of an aggressive unwinding of the balance sheet. After the atrocities in Bucha, Russia will likely be hit with fresh sanctions today. We'll be live in Brussels with the latest. And JetBlue shocks the aviation world with a $3.6 billion bid for Spirit Airlines that could unseat a deal already agreed with Frontier. Welcome to Bloomberg Surveillance Early Edition. I'm Guy Johnson in London with Matt Miller and Kaylee Lines in New York. Anna Edwards is off today. Kaylee, let's talk about the markets. Hong Kong reopening, really interesting Asian session.
Yeah, and it was a risk-off sentiment that dominated the Asian session, Guy. As you said, Hong Kong opened back up from a holiday. You had Hong Kong lower, you had Japan lower. Put it all together, and the Msci Asia Pacific Index was off by about 1.4%. This really is a market digesting those hawkish words from Lael Brainard and awaiting the FOMC minutes later on today. Now, of course, that rippling through the bond market as well, and in a big way. That global bond sell-off definitely evident in the Asia Pacific region. You had the two-year yield in New Zealand up 19 basis points. That is a 4 standard deviation move. And at 3.17%, that is the highest for that yield going back to 2015. You also had the 10-year yield in Australia touching the highest since 2015. It ended the day about 8 basis points higher, 2.93%. This is obviously a bond market, Matt, that is preparing for more hawkish central banks, not just here in the U.S., but across the world.
Yeah, absolutely. And we have very high yields here in the U.S. as well, or at least the highest since 2019. Take a look at S&P futures, right now down 1/3%. That after a drop of 1 1/3% yesterday, because those higher yields are spooking tech investors and pushing the NASDAQ down. And of course, the S&P 500 is so tech heavy as well. The 10-year yield continues to climb as investors let go of that debt. 2.6163%. No longer inverted in terms of the 2s and 10s. We came out of that inversion yesterday, but the 10-year yield continues to rise as the Fed comes out more hawkish. Yesterday, Brainard, George, and Daly all saying inflation is the #1 enemy here. NYMEX crude, speaking of inflation, up another 1.2% today, still around 103 a barrel. Yesterday when we saw it, it was around 105, almost 106 at this time. It then came down throughout the day and is back up now. 103.21 is your quote for Texas Intermediate. And Bitcoin, the same story. Yesterday we saw it around 45, 46,000. It had gone up, and now it's come back down from midnight. That's what we quote here. So it's down 1% from midnight to 45,386. Still a relatively high level, but maybe a little bit of a risk-off signal. Guy, what are you seeing in terms of European markets?
Well, let's talk about the equities. It's a sea of red, Matt. That's the picture, as you can see here. London outperforming a little bit. Commodities doing a bit better. DAX is down by 1%, just over 1%. CAC down by around 1%. Let's look at what is happening cross-asset right now as well to get an idea of what is going on. Equities really not at the center of the action. It is a bond market story front and center around the world, as we've been hearing. Stock 600, therefore, down by 0.9%. Bunds are selling off once again. Actually, I would argue the real pressure is in the periphery. Remember, Pep has ended. The ECB goes into a quiet period tonight. Deutsche Bank has a very aggressive call on rate hikes from the ECB. Euro dollar below 109, below 110, 109, but actually a little bid this morning. Brent crude, as we've just been hearing on the oil markets, 107, nearly 108. We are up by around 1%. But keep an eye on what is happening with coal. That is the story. Coal yesterday rising rapidly. Today, we are expecting further sanctions, Kaylee, to be coming out when it comes to Russia. Let's take a look at those Russian assets. The equity market is bid this morning. The ruble continues to be sort of fairly flat. It remains surprising how well it's bid. But to be honest, I'm not sure that's a clearing price, as Damien Sassa continues to point out. Anthony Blinken talking about the idea that it should be under further pressure. Maybe sanctions do that and continue to edge away at what is happening there. That's the picture with Russia right now, but the sanctions story, Kaylee, is going to be front and center today, and the pressure just keeps getting ratcheted higher and higher.
Absolutely, Guy. We'll be looking for those sanction headlines all day today. And what else are we looking for in the day ahead? NATO foreign ministers are meeting in Brussels as the U.S. and allies coordinate on those new sanctions on Russia we have just been discussing. You also will have the U.S. FDA advisory panel meeting to discuss the use of future COVID-19 booster shots. At 10:30 a.m. New York time, oil executives are set to testify on gasoline prices at a House hearing on Capitol Hill. And finally, the big one. The Fed minutes are due at 2 p.m. New York time. Matt.
All right, the Fed is stepping up its tightening rhetoric. Yesterday was pretty amazing. Governor Lyle Brainerd says the central bank will raise interest rates steadily while starting balance sheet reductions as soon as next month that will be accelerated compared to the last QT. Listen to what she said.
Given that the recovery has been considerably stronger and faster than in the previous cycle, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps compared with 2017 to 19.
Let's get more with Bloomberg's Danny Berger. Of course, we also heard from Esther George and Mary Daly, so it looks like everybody is coming out very hawkish.
Yeah, they really are singing one note considerably more rapidly. Those two nearly back-to-back adverbs really spooking the market. And it makes sense that they did, because previously what we had heard of the balance sheet reduction came from Joe Powell saying that this time around it would follow a similar playbook to last recovery. Now the market needs to wrap their heads around a balance sheet reduction where the maximum cap is likely to be larger. Last time, the maximum was $50 billion per month. This time, estimates are anywhere from $80 billion up to $120 billion, more than double that figure coming from Inflation Insight and Omar Sharif over there. So what sort of knock-on effect will this have to markets? I was speaking with Jordan Rochester of Nomura earlier, who said that all we need is $100 billion, and that will upset markets. And look, I have a chart for us, for our radio listening audience, that often is considered a chart crime, so I'm going to tread carefully here. I'm looking at the Fed balance sheet and the S&P 500, both of them rising in tandem. Now, I don't want to imply that correlation is causation here, but many investors think that this is the main reason. Okay, but Matt, many investors think that this is the reason, that because the balance sheet has gone up, that the S&P 500 has gone up. So I'm not implying it, but enough people believe it that it could have a psychological effect at the very least. But for some like Deutsche Bank, it's not just psychological. They think that there will be a recession next year and that equity markets will tumble 20% into the summer of 23, Kaylee.
All right, Bloomberg's Danny Berger, not implying anything, but informed reporting for us this morning. Now let's get to the latest on Ukraine. The U.S., EU, and G7 are preparing to impose more sanctions on Russia. This is following the discovery of civilian murders in Ukraine. Ukraine's President Volodymyr Zelensky urged the United Nations yesterday to do more to stop Moscow's aggression.
Either remove Russia as the aggressor and a source of the war so it cannot block decisions regarding its own aggression, its own war, and then do everything that we can do to establish peace.
Let's get more on the fresh round of sanctions with Anne-Marie Horder, our Washington correspondent, and Maria Tadeo, our European correspondent. They're in D.C. and Brussels, respectively. Anne-Marie, let's start with you. What exactly are we expecting to hear from the Biden administration today?
It's really a lot of the more of the same in terms of the sanctions playbook that the United States has been going after. So you're going to see financial institutions, state-owned enterprises, also Russian government officials as well as their family members. Now, the Wall Street Journal has a little bit more details on exactly what they're going to be targeting. Sberbank and Alpha Bank was mentioned in their report, as well as the United States, potentially what the EU may do as well, going after President Vladimir Putin's two daughters, Maria and Katerina, as well as from the United States, a ban on all new investment in Russia. We should also note that we're going to be hearing today from Treasury Secretary Janet Yellen. She's going to be speaking in the House, and this comes as we have these fresh new sanctions, and she's going to really warn about the economic repercussions that are going to be affected globally due to this war. And two issues she will highlight that we're going to really want to focus on is where Russia plays a very outsized role in the market, and of course that's energy security as well as food insecurity.
Anne-Marie, thank you very much indeed. Anne-Marie in D.C. Really nice Khodorkovsky story there as well from Anne-Marie in D.C. Let's talk about what we're getting out of Brussels. Maria Tadeo standing by, our Europe correspondent. So are we going to get the coal sanctions today? Is anybody going to resist, or is this a done deal?
Well, Guy, if you ask me, this is now a done deal. And in fact, we have a lot of detail now from this fifth package of sanctions that the European Union will very much likely approve today. We know it's about 10 billion euros of Russian exports into the European Union will be blocked. Of course, the highlight measure from this is that ban on coal. And essentially the way it works is that buyers will be given 3 months to wind down their contracts. And after that, they won't be able to sign new ones. There will also be an export ban of European technology into Russia for about another 10 billion euros. So overall, this package is 20 billion euros. But Guy, in many ways, as I said, this is a done deal, and the conversation is now moving into what's next. And I hear already there's works around a sixth package, so a new one that would come into play here. And today, Ursula von der Leyen and the head of the European Council, they both said, ultimately, we're going to have to start looking at oil. And this is pressure that is also piling, particularly after those pictures came out of Bucha. But also, let's just remind ourselves that the invasion is going. So this is not going to be the last of it. The Europeans are preparing themselves to see more atrocities committed on Ukraine, and then, of course, the response to that. So oil is very much now up for debate.
It is incredible to watch the sequencing here. You do wonder whether that is being held back because of the expectation of worse still to come. Maria, thank you very much indeed. Bloomberg's Maria Tadeo, our Europe correspondent, joining us from Brussels. Let's turn to corporate news. JetBlue has offered to buy U.S. budget carrier Spirit. The price tag, $3.6 billion. That potentially spoils a competing bid, a lower bid by rival Frontier, and it could reshape the landscape for the ultra-low-cost air travel market in the United States. The domestic market is booming stateside. Siddharth Phillip, Bloomberg Europe Airlines senior reporter, joining us now with more. What does Robin Hayes want with this deal? Why is he stepping in at the last minute, Robin being the CEO of JetBlue?
Absolutely. So for JetBlue, this would be an opportunity to get into the sort of top 5 carriers of the US. And given the fact that leisure travel and budget travel, that's basically the sector that's booming at the moment, with business travel and overseas travel pretty tepid at the moment. So Spirit Airlines would offer a great opportunity for JetBlue to actually consolidate its network, focus on leisure destinations in the US, and sort of expand from its main areas of New York and Boston.
Of course, Frontier wants Spirit too. What was their response to the JetBlue bid? Will they have to come in with a higher number?
So Frontier has been it wasn't very happy about JetBlue's bid, and they said that essentially it wouldn't be a good fit, and that their bid was far more attractive in terms of offering consumers better sort of value for money, and JetBlue would not really do that.
All right, Bloomberg's Sid Phillip in London, thank you so much. Both JetBlue and Spirit Airlines, we should mention, down about 2.5% in pre-market trading here in the U.S. And let's get a look at some other stocks moving in pre-market here in the States. I want to check, of course, on Twitter, up 30% in just the last 2 sessions on a rapidly unfolding series of events. First, news of Elon Musk's passive 9.2% stake. Then he gets a seat on the board. Then Twitter says, yes, we are testing an edit button. Then Musk refiles to say, actually, yes, I am having an active stake in this company. Twitter giving back a little bit of gains this morning, down about 1.3%. Also moving lower, Stellantis for a second day, really along with a lot of its automaking peers. The concern here is that more sanctions on Russia could lead to more supply chain issues, which, as we know, car companies already have been grappling with for some time. Stellantis down 3.3%. One car maker, EV maker, actually bucking that trend is Rivian. Reported first quarter production numbers after the bell yesterday. Actually was able to deliver a little over 2,500 vehicles despite those supply chain issues. So getting a little lift in the pre-market guy, up about 1.7%.
Kelly, great stuff. The Ukrainian President Zelensky, speaking to the Irish Parliament right now, the Dáil, making comments talking about the fact that Russia hasn't abandoned its plans to occupy all of Ukraine, making that point forcefully. If you get any more headlines, we will bring them to you. Matt, let's talk about what is happening with the markets. We need to dig in to what is going on in the bond market. We're going to do that in just a moment. Peter Schafferik's going to be joining us, global macro strategist at RBC Capital Markets. We're also going to discuss fresh sanctions on Russia. Julie Norman, UCL lecturer in politics and international relations, joining us a little bit later. Plus, going full manga, David McCormick, who once championed diversity and inclusion under Ray Dalio, is now trying to out-Trump Dr. Oz in Pennsylvania, in the Pennsylvania race that could become one of the most expensive Senate primaries ever seen. You can read more on that story, actually, on today's Big Take. All you got to do for that, go to your terminal, NI Big Take. You'll find that fantastic story. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance. We are simulcast on both Bloomberg Radio and on Bloomberg Television. I'm Matt Miller with Kaylee Lyons here in New York. Guy Johnson out in London. Anna Edwards is off this week. I'm looking at value versus growth because we've heard this narrative that there's a rotation into value from growth. We kind of hear that at the beginning of every year, and it doesn't seem to pan out. Again, it's not happening the way you might think that it is, even as Treasury yields rise. We saw 260 today, and typically higher yields mean pain for tech stocks. Ksenia Galuchko joins us, Bloomberg Equities editor, to talk about why this is happening, what we're seeing. I mean, indeed today, Ksenia, we're seeing tech stocks take a hit, but you're not seeing the rotation that you may have thought we would. Why?
Yes, it's been a fascinating period. So going into this year, everyone expected value stocks to outperform massively because of the rising bond yields. But they only had a few weeks of outperformance, and growth stocks, and especially U.S. tech, has been extremely strong. And the reason behind that is that investors generally tend to prefer big U.S. tech. They see that as the most profitable sector. They see it as being able to overcome any inflationary concerns, pass on the higher costs of products to the consumers. And that's why the NASDAQ, for example, has rallied about 14% since hitting a bear market in February. So this has been a pretty impressive outperformance. But again, like you said, today tech is under pressure after the hawkish Fed comments.
Bear market rally, is that how we should think about what we've seen over the last few days from the tech sector?
Absolutely, yes. So Morgan Stanley's Michael Wilson has been a big proponent of that theory. He says we should sell this bear market rally, that it will not continue, that it is very dangerous, and that the correction in U.S. stocks, especially tech, will continue. At the same time, the majority of strategists out there on Wall Street are still very bullish on the U.S. stock market generally. And they say that gains, although much more muted compared to the previous 2 years, will continue despite the hawkish Fed, despite higher inflation, and despite all the other concerns like war and economic growth slowdown.
Ksenia, great stuff. Thank you very much indeed, Ksenia Galuchko, on what is happening in these markets. Of course, for more market analysis, check out MLIV, Markets Live, on your Bloomberg terminal. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Guy Johnson in London. Anna Edwards is off this week. Now, keeping you up to date with news from around the world, here's the first word. China reported more than 20,000 new cases of coronavirus Tuesday. The increase was driven by surging infections in Shanghai, where authorities are building the world's largest makeshift isolation facility. A convention center is being converted to house more than 40,000 patients. Bank of America plans to bring all of its U.S. employees back to the office by June 1st. That includes those who haven't been vaccinated against the coronavirus. B of A employees will still have some flexibility to work from home, but they are being strongly encouraged to collaborate with colleagues in person. The European Union's foreign policy chief called a summit with China's President Xi Jinping a, quote, deaf dialogue. Josep Borrell said China didn't want to discuss the war in Ukraine. That cast doubt on how much cooperation Beijing will offer to end the fighting. And an ex-oligarch says that from Vladimir Putin's perspective, Russia is already at war with the U.S. and its Western allies. Mikhail Khodorkovsky said that was once Russia's richest person. The exiled oil mogul told Bloomberg that because of sanctions and arms shipments to Ukraine, Putin views Russia as fighting the West on Ukrainian soil. And Matt, this raises a question, and you pointed out this is one of our top read stories on the Bloomberg terminal today. When the West talks about not wanting to escalate the conflict any further, maybe it's already escalated to one party, Vladimir Putin.
Yeah, I thought it was an amazing story. Anne-Marie Horton has been covering Khodorkovsky from the beginning, so great job on her part there. On the other hand, Khodorkovsky hasn't talked to Putin in 18 years. Putin put him in a gulag, guy, for like a decade, right? So they're not huge fans of each other. Maybe you need to take his comments with a grain of salt.
But it's interesting because he is briefing European officials and he is briefing officials in D.C. as well. So his point of view is going to be heard. And this is really going to come down to what NATO wants to do next. If this is effectively a proxy war in which NATO is already involved, how is that going to ultimately impact what comes after sanctions? Because we're reaching the limits of sanctions, right? We're getting to the end of what is going to be possible. And in theory...
we haven't applied the one main sanction that we should yet, right?
We haven't. We haven't, but it feels like it's being sequenced, doesn't it? As the bad news comes out, we're getting tranche by tranche worse and worse sanctions from a Russian point of view. After that, like if you believe you're Clausewitz, you go into the military sphere. That potentially could be what comes next. Anyway, we're going to discuss the rates story next. We're going to focus back on the Fed. Peter Schafferick, global macro strategist at RBC, is going to be joining us next. That is what is coming up. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here's what you need to know. Ahead of today's FOMC minutes, traders are now pricing in 225 basis points of hikes from the Fed this year. On top of that, Lael Brainard is warning of an aggressive unwinding of the balance sheet. After the alleged atrocities in Bucha, Russia will likely be hit with fresh sanctions today. Penalties will be increased on financial institutions and state-owned enterprises, plus sanctions will be placed on unspecified Russian officials and their families. And what do we need to know about JetBlue? JetBlue shocking the aviation world. It has put through a $3.6 billion bid for Spirit Airlines that would unseat a deal already agreed with Frontier. Spirit is apparently evaluating the offer. I'm Guy Johnson in London. Kaylee Lyons and Matt Miller are in New York. Anna Edwards is off today. Matt, what's happening in U.S. markets ahead of the open?
Well, Lael Brainard is really what's happening still today. After yesterday, we saw the S&P down 1 1/3%. A client writes into me that called her commentary the bearish shot heard round the world. S&P futures are down 0.5% again after she said the Fed could unwind the balance sheet at a faster pace than it did last time. Remember, last time we got to $4 trillion and barely came down to 3.5 before we shot up to 9 again. So they should certainly be able to do that. The 10-year yield up again, 2.6144%. So we're no longer inverted. That's higher than the 2-year by a decent amount, a substantial amount, and I think about 6 basis points. And that's the highest we've seen since 2019. So these yields climbing, as Ksenia Galuchko was telling us, that's no good for techs. NASDAQ futures are down as well. Crude oil right now up 1.2% at 103.20. That's for Texas Intermediate. And Bitcoin is down 1.3%. Again, it's highly correlated with stocks. So when you see stocks down, Bitcoin is down as well, but still holding at $45,277. Kaylee, what are you seeing in terms of pre-market movers?
Well, I want to take a look at the action for JetBlue and Spirit. As Guy mentioned, JetBlue making that $3.6 billion bid for Spirit, knocking out potentially rival Frontier, who had already made a lower bid for that low-cost carrier. JetBlue really trying to get a firmer footing in the budget market in the U.S. But after that news, which of course broke about half an hour before the close of trading yesterday, JetBlue is down about 3.5%. And after a 22% jump in the final 30 minutes of trading yesterday, we are seeing Spirit retracing some of that down about 2.7%. Also moving lower is Tesla. Of course, this is a large cap, technology-oriented company, very, very high multiple. So it's being put under pressure by higher rates, 1.9% decline for that stock in early hours. And a little bit of a decline for Twitter as well after a 30% gain in 2 days on a series of events unfolding related to Elon Musk's active stake now in the company. That stock is softer by just about 0.9% before the bell guy.
Absolutely. We're 2 hours into trading here in Europe. Let's talk about where we are with our markets right now. Stock 600 continuing to track lower. We're down by around 1%. Car stocks are down today. Luxury stocks are tracking lower as well. Think about the fact that we're going to be seeing Russian families being sanctioned. That could certainly be a factor into that story. BTPs, the Italian bond market, continues to remain under pressure. Spreads are widening, quarter periphery. Pay attention to that. The ECB certainly will be. It goes into its quiet period this evening ahead of the next meeting. Euro dollar is actually bid, but again, that bid is starting to fade. We're still south of 109.13, and that is the coal trade. We're up by another 6.48% on European coal today. It rose yesterday. The expectation is, as we were hearing from Marie a little bit earlier on, that we will see sanctions being applied to Russian coal as of today. Yeah. Let's talk about the Russian assets, Matt, and just get a quick idea of what is happening here. This is the picture. Actually, the stock market is reasonably well bid today. The ruble is coming back a little bit, but it's absolutely flat to my mind. I think it's a real struggle to try and understand exactly how we price this right now. The market is swinging all over the place, but there's so much stuff going on under the surface in terms of the support that's being applied. And again, similar sort of story, Matt, for the bond market right now. I'm not sure how real these markets are.
Can I just point out a couple of things I want to quickly point out, Guy?
Yeah, okay.
One is that...
I got that impression.
The one is that European governments are paying Putin for his gas. They say they're paying in euros, but they're exchanging those euros for rubles at his bank at his exchange rate. So that's certainly helpful in terms of getting the ruble back to where it was pre-war. Also, coal is something they want to get away from anyway. And they really only import that much coal from Russia because they're trying to phase out their own, as you are in the UK as well, I'm sure, their own coal mining industry. So this isn't the most difficult sanction. This is the problem, right? The most difficult sanction, the one that really would hurt Putin and that would cut off funding for his war effort, is if they would stop buying oil and gas. And this is the one that they're not doing.
Matt, but that's where we are. That's the sequencing story right now. You get Bucha, you get coal. What do you? The pictures coming out of Mariupol could be potentially even worse.
Yeah.
Is that when you step up to that next level? I don't know, but certainly that's what people are talking about right now here in Europe.
Yeah, and we'll see what happens in Mariupol if that forces Schultz's hand to take bolder action. I want to give you quick breaking news on what's going on in Hong Kong. Yesterday we were talking about Carrie Lam saying that she won't run for a new term and speculating about who could fill her seat. Now we see her number two, John Lee, right now speaking live, saying that he will seek that post. So he is going to talk to Beijing, if he hasn't already, and look to fill her position when she... well, she's got to run for re-election. She's not going to run for re-election, so ostensibly he'll run for election. But of course, these things are carefully planned by the Central Committee. More now on the Fed as officials step up their rhetoric on tightening. Kansas City Fed President Esther George spoke yesterday exclusively to Bloomberg's Michael McKee.
When you look today at where the balance sheet is and the conditions in which we'll be doing that, I think it easily argues for going faster and moving along at a quicker pace than we did before. We have a ways to go to get this accommodation out of the economy.
Peter Shafrick, global macro strategist at RBC Capital Markets, joins us now. And Peter, you know, to me, the most interesting thing is not only how hawkish they have all become, and they're singing from the same hymnal, I think someone said earlier, but that they're talking about going up to the neutral rate, and Esther George said they may even need to go through it. Historically, when that happens, it sends the U.S. economy into a recession. Is that your base case scenario?
Well, first of all, I think you're absolutely right. I mean, it's a very crucial step to go through neutral, wherever neutral exactly is. And one of the things that we are expecting is that the economy will start slowing down. Whether we hit a recession is a different story, but it's definitely in the second half of the year. We already, and pretty much everyone had already expected a slowdown anyway, and that's most likely going to be exacerbated by the rate hikes that we're going to see.
But will an eventual slowdown actually start to slow the pace of the Fed's rate hikes? Do you think they're credible when they say they can move at each and every meeting this year if they start to see a deterioration in the data in the back half?
Yeah, what we are expecting is for the next two meetings, we're going to see 50 basis point steps. That seems to be, as one of my clients said it, nailed on. And thereafter, actually, we do think that they're going to slow things down a bit, that they're only going in 25 basis point increments. We see that lasting for the entirety of this year and into early next year, and we'll have to see what's happening thereafter. I mean, if we're right and if the economy starts to slow, it's probably going to last not much longer than this year.
So what does that mean for the bond market, Peter? We already see a 10-year Treasury yield at 2.6%, the 2-year just about 6 basis points below that. How much more legs do you think the bond sell-off has?
Yeah, I think the interesting thing is when you look at what the forwards are currently pricing in the front end of the curve, we're not far away from what the dot plots are telling us. So unless sort of we get another significant shift higher, which is possible in the early phases of the 50 basis point hikes, and where we're not really sort of seeing the slowdown effects of the economy coming through, we could probably push a little bit higher. But towards the second half of the year, we actually think that this is going to peter out. So we're probably not too far away from the peak in bond yields. We're probably not quite there yet, but again, the forwards are higher than spot.
Peter, what is aggressive QT? The kind of aggressive QT that Leo Breno is talking about, worth in basis points. Can you give me your calculation?
Yeah, I mean, first of all, I actually can't give you sort of the rule of thumb because it's very, very difficult how much that's worth. And we're probably priced in a much more aggressive path of QT already. And, I mean, Powell has indicated that we're probably going to learn something from the minute. That's why everyone's watching it. But when you sort of look what's the likely range here, we reckon that we're probably going to see a cap on reinvestments that's going to be much higher on treasuries than where it was before. Let's call it 60 billion a month. And that's probably going to be, apart from the refunding month, that's probably going to be higher than what's coming due anyway. So we're going to see a relatively quick pace here. But again, I think in terms of what it means for the market, we've probably priced in a lot of that scenario already.
Peter, let's talk about what's happening with the ECB. Going into a quiet period this evening, Deutsche out with a really interesting note overnight. With Eurozone inflation likely to be sustained at 2% or more, we see the ECB raising rates by 250 basis points between this September and next December. Peter, what do you think about that call? Do you think it's too aggressive? How hard will the ECB have to go?
Well, first of all, I'm totally on board that the ECB will have to do something. And I'll come back to the magnitude in a second. But I mean, one of the things that's absolutely key for me is what the ECB has always had as their defense is that the inflation expectations in Europe have been very low. And obviously coming out of a period where disinflation was the current concern rather than inflation, that was a mighty argument. But when you look at it now, that's not the case anymore. On spot, on forward, 5-year, no matter what you look at, the inflation expectations are in part significantly above the target. So that's no excuse anymore. So, the only other sort of excuse that the ECB can waive is that wages haven't been really going up, but that's probably just a question of time. So the ECB will have to do something, and they've indicated and they've turned bearish, and that's very clear. As regards the magnitude, in my mind, it's a similar question as you just asked me for the US. We're probably going to see a slowdown eventually anyway, particularly if the US slows down. And if that's the case, then probably the magnitude that the ECB can deliver is maybe not going to pan out as much as you just indicated.
Peter, one of the beauties of, I just moved back to the US last month, and one of the main benefits is I can buy a Porsche here for a lot cheaper than I can buy a Porsche in Stuttgart, where they're actually made. Part of that has to do with the amazing amount of taxes that Europeans are willing to suffer. But the other part is the exchange rate. We've been stuck at 109, 110, it feels like for a while now. Is that to the benefit of the European economy? Does the ECB think about that when making policy decisions?
Well, as the ECB always says, this is one part of their consideration, but it's not a policy tool. And I think that's probably truer now than it has been in the past. But because when you look at it now, I mean, one of the issues that we currently have is obviously sort of the externally induced prices. So whereas previously the ECB was always concerned that the euro is too strong, I don't think that this is their concern at the moment. If anything, then probably to the contrast. But I mean, I actually think that the domestic economy is in a much better shape now. I mean, we'll have to see once everything is said and done with the war impact and the second round effects, how strong it is then. But compared to the previous, the domestic economy is much stronger, which means that the external sector is less important than it used to be, and therefore I think the exchange rate itself is probably less relevant than it was in the past.
All right, Peter Shafrick of RBC Capital Markets, have to leave it there, but thank you so much for your time this morning. Now, we are getting some breaking headlines out of the Russian finance ministry. Russia saying that a foreign bank has rejected a $649.2 million Eurobond payments. They're commenting on the 2022 and 2042 Eurobond payments. Russia saying they transferred those payments in rubles to NSD, that is Russia's national settlement depository, a really key component of Russian financial infrastructure, but really just speaks to the difficulty Russia is going to have staying current on its debt obligations, especially in light of the action taken by the U.S. Treasury yesterday to not allow payment through U.S. accounts. And this is, of course, as we're expecting more tightening and more sanctions announced from both the U.S. and the EU today. We'll discuss those fresh sanctions on Russia with Julie Norman, UCL lecturer in politics and international relations, coming up next. This is Bloomberg.
Connection lost.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
They shot everyone they saw, one witness said about Putin's soldiers. This, honorable members, is what is happening when Putin's soldiers occupy Ukraine territory. They call it liberation. No, we call it war crimes, and we really have to give it this name.
European Commission President Ursula von der Leyen addressing Parliament earlier today in Brussels. NATO foreign ministers are meeting in Brussels today as well. The US and allies coordinating a new round of sanctions on Russia. Joining us now for more analysis on this, Julie Norman, UCL lecturer of politics and international relations and co-director of the Center on US Politics. Good morning. So we're getting sanctions, and these sanctions appear related to the atrocities, the alleged atrocities that we've seen in Bucha. My question is, what comes next after this? Are we basically in a sequencing process as the news out of Ukraine gets worse and worse and worse, so the sanctions story will be ratcheted up and up and up? When we get to Mariupol, are we going to be in a position where we're going to be sanctioning Russian oil and gas?
Well, we certainly are seeing a certain kind of cycle emerge, and certainly after the atrocities that were reported over the weekend, both the U.S. and EU and NATO are likely to impose new sanctions today. From the U.S., that is likely to include a ban on all new investment in Russia. This, of course, comes off the back of the Treasury announcing a halt on any U.S. dollars from U.S. banks to pay Russian debt. And from the EU and NATO today, we're expecting to hear more of a focus on potential sanctions on coal imports from Russia, which is a bit of a hit at the energy market, but not nearly as substantial as, say, oil or gas would be. So
yeah, but Julie, even if Europe does get to the point where they actually take action on energy, what powder does that leave still in the keg? Are we going to get to the point where there's nothing else left to sanction, and what does that leave the West with?
Well, that's certainly one of the difficult moments right now, is trying to figure out what to do beyond sanctions, because the sanctions can have some effects. Obviously, we're seeing a contracting of the Russian economy, but so far has not really seemed to shift Putin's approach to this war or pushed him any closer to a withdrawal or a ceasefire. So the sanctions, of course, are always coupled with, again, the military aid. The U.S. announced $100 million further of javelins yesterday to continue with the anti-tank and anti-armor weaponry. But in terms of what else the West can do, unfortunately, their hands have been somewhat tied from the beginning with the sanctions and military aid because of the commitments, and many think rightly so, from NATO not to get directly engaged in the conflict for risk of further escalation.
I wonder about the ruble bouncing back. It does seem as though European payments for oil and gas are not only helping to support the Russian economy, fund the war, but also have stabilized the ruble now because they're exchanging that at Putin's exchange rate. Is that a concern at all? Is that something that EU leaders are trying to keep a little bit quieter?
Oh, it's certainly a major concern. And again, Putin played that very strategically in terms of trying to push the payments for energy in rubles. There was a bit of a kind of standoff last week with the EU trying to figure out how to be able to negotiate that and work with that. Again, all of this, I think, is leading into a larger discussion, of course, ongoing in the EU about how to wean off of this dependence on Russian energy. But we all know that's not going to be automatic. Right now, as you said, I think it's about, we've heard reportedly like $30 billion from Europe has been going to Russia just since the start of the war for energy alone. But again, that's very difficult to switch off overnight, especially with supplies like natural gas.
Why, when you see the pictures out of Bucha, Julie, if, it's right now they're allegations, but if the Russians are just systematically executing civilians in Bucha, is that not worth taking the hit of shutting off gas from Russia automatically?
Certainly, and I think that's where the moral argument for this rightly is. Again, realistically, though, I think some European states are worried that the cost to them would be even more than the cost to Russia. Right now, Russia would still have other markets to export their oil and gas to. For European states, that would be taking a major risk, not only for quote-unquote higher energy prices, which I think many are willing to absorb, but actually the risk of recession and kind of derailing their own economies and putting a worse hit on them than Russia would potentially get. So all of that is being weighed right now. And again, through all of this, you need to get the entire bloc on board with whatever decision is made. So many states are ready to make that move already. Other states are just becoming a bit more willing to discuss it.
And sanctions, to a certain extent, do have a domestic role. That's kind of sanctions 101. Maybe the idea is that you save some of this for later when the picture gets worse, because if you don't, then the next option, potentially, Julie, could be military action. Julie Norman, UCL lecturer of politics and international relations and co-director of the Center on U.S. Politics. Thank you very much indeed. Coming up later this morning, Evelyn Farkas, former U.S. Deputy Assistant Secretary of Defense for Russia, Ukraine, and Eurasia. That conversation coming up 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Guy Johnson in London. Now a look at what we're watching today. I'm going to be watching the Fed minutes dropping at 2 p.m. Eastern time. The reason why I'm watching it is because Jay Powell literally told me to in his press conference after the Fed hike rates last month. He said that they will have a more detailed discussion on the balance sheet, laying out pretty much the parameters of what the Fed is looking at, and especially after the comments from Lael Brainerd, the Fed governor, yesterday about a rapid reduction in the balance sheet, potentially as soon as May. The market is going to pay attention to each and every word, Matt.
All right, you know what I'm watching is closely related to that, and it is really Michael McKee's interviews. Yesterday, McKee had Esther George in an exclusive interview, and she said that the Fed may have to go up and even possibly through the neutral rate. Now, as we all know, or if you don't know, there isn't an exact neutral rate, right? People make up different ways of figuring out what it might be. John Williams, head of the New York Fed, has a model, the Laubach-Williams model, that he used to release, I think, quarterly until 2020. Amidst the pandemic, he stopped. But McKee has an interview with him next week, so I'm going to see if he'll start releasing that again. Last time it was 0.4%, Guy.
Okay, that's a great thing to be watching, Matt. I'm going to be watching Levi. Numbers are coming out, but I also want to know. Kaylee keeps telling me the skinny jeans are dead.
Right? Levi's.
Are we Levi's? Are we transitioning to flares? What's happening there? I think that's probably one of the critical questions that we need to be watching out for. We're going back to the 70s after all. Also, I want to know what's happening with the consumer. I want to know what's happening with supply chains. I want to know what this earnings season is going to be looking like, because I think it's going to be absolutely pivotal to these equity markets. I don't think we're talking about it enough. That's it for Early Edition. Bloomberg Surveillance with Tom, John, and Lisa is ahead. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA.
which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
From COVID inflation to conflict inflation.
I don't see energy prices coming down that quickly. I don't see food prices coming down that quickly. And I think that's going to be a real problem globally.
Higher inflation is eroding confidence, and that's been true now for many months.
The Fed now has to come out guns blazing, declaring that they're going to conquer inflation because that's their job.
The Fed will ultimately be successful in knocking the inflation rate down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down 0.5% on the S&P TK. What a move in this bond market.
Huge move in the bond market. And John, you can look at it short term off the Brainerd comments. John, did you know it's Rapid Pace Wednesday? I think that's where we are after what we heard from the presumptive vice chairman. But also the bond market is moving away from what we remember. John, the 2-year yield, particularly Valentine's Day before the pandemic, 1.43%, and look where we are today.
I still love that you base everything off Valentine's Day on any given year. We'll leave that to one side. Tom, the question we all want to know, give us the answer. Are you reading the Fed minutes a little bit later this afternoon?
No, I'm not reading the Fed minutes. Vice Chairman Presumptive Brainerd will read them for me.
Chairman Powell teed it up, Lisa. Look ahead to the minutes a little bit later.
Honestly, we had this feeling that we were going to get some kind of bombshell about how quickly they're going to wind down the balance sheet in the meeting minutes. We knew that they were really interested in moving and moving quickly. Then Lael Brainerd comes out yesterday and says, hey, by the way, we're going to move and we're going to move quickly, and everyone freaks out. So you start to wonder how people respond to the actuality of words that we all have been expecting for a couple weeks now.
I read the transcript from the news conference on March 16th, yesterday evening, and compared it to what we learned from Governor Brainerd in her speech yesterday. Lisa, hardly any daylight between the two things.
But
what was new about yesterday?
Well, that's the whole thing. And we said this even in that press conference. We said we did not hear a dovish Fed. We said, frankly, we're surprised that people did not pick up on some of the comments about quantitative tightening. And here we are with suddenly people being surprised by the idea of quantitative tightening.
I have to say, though, if you are a Fed dove and you start your speech with a Volcker quote, you're probably going to get some attention. And Governor Brainerd, Tom, that's exactly what she did yesterday.
Well, it's the history that we see there, and it's a different kind of high inflation, John, now than what Mr. Volcker had. I'll let the pros talk about it. John Williams to talk with Michael McKee here in a number of days. But the answer is we're coming off such a low base that even Lael Brainerd doesn't know where restriction clicks in. That's a huge part of this debate to May 4th.
We've seen some big moves in this market, so let's whip through the price action for you. On the S&P 500, on the NASDAQ, futures lower, negative, down 0.5% on the S&P. On the NASDAQ, we're down about 0.8%. Yields higher again on a 10-year, up 7 or 8 basis points to 262.38. And the dollar has been surging recently, 109.10. The dollar index, Lisa, very close to a 100 handle.
How much is this basically pricing in the fastest pace of Fed tightening going back to 1994, which is what we're seeing currently in some of the futures markets? 10 a.m., we listened to Treasury Secretary Janet Yellen. She's going to be testifying to a House subcommittee. How has her language shifted? And how, frankly, has the overall language of policymakers from the U.S. to Europe shifted in terms of the economic fallout? And this comes as Deutsche Bank starts to project a potential recession in the United States. Janet Yellen saying that this conflict will have enormous economic repercussions for the world. Perhaps we'll get more insight into just what she sees that meaning for the U.S. economy. At 10:30 a.m., I know that you have your popcorn, John. Oil executives testifying in front of the House subcommittee. This hearing is titled Gouged at the Gas Station, Big Oil in America's Pain at the Pump. There are a number of executives that are going to be joining this. Exxon, BP, Chevron, Shell, Devon, all of these energy executives are going to come and talk about how they are adding to some of the supplies at a time when you've got a lot of animosity, particularly coming from the Democratic side toward their industry. And then at 2 p.m., we get those FOMC meeting minutes. And again, let's just talk about what Lael Brainard actually said yesterday. The committee will continue tightening monetary policy methodically through a series of interest rate increases, and by starting to reduce the balance sheet, this is the important part, at a rapid pace as soon as our May meeting. John, we've been expecting this. This is what we knew. And this is what triggered a massive move in the bond market and, frankly, a risk-off feel in stocks.
Bramo, thank you. This was Chairman Powell on March 16th in the news conference. It'll be faster than the last time. And, of course, it's much sooner in a cycle than last time. I'm sure there'll be a more detailed discussion in the minutes to our meeting that come out in 3 weeks. TK, 3 weeks is up today.
Well, three weeks is up today, and that's fine, John, but I'm going to go back to the old data dependency, and it's not only data dependency of the Fed, and John, I'll bring this up right now. Does the Fed adapt and adjust to what the ECB decides to do? I don't think that's a question that can be ignored.
Well, we don't know what the ECB is going to do, Tom. Deutsche Bank came out with a massive call yesterday, though. And, Tom, we can talk about it a little bit later, but your thoughts on this. Deutsche Bank have got an ECB call now of 250 basis points worth of hikes between September coming up, and next December. Tom, that's a lot of hiking for an ECB over a little more than a year.
Well, even more original. Commerce Bank wrote a nice note today where they made clear the ECB is way, way, way more difficult than the Fed. I thought it was a very terse note, and of course Deutsche Bank with some very strong language as well. But John, the answer here is we're going to stagger day by day through this, along with Ukraine, and the answer is I think Lael Brainard mentioned, it's original monetary policy they're committing.
I put that Deutsche Bank quote out on Twitter yesterday, Lisa. Bramo, can you imagine the amount of pushback I got to that ECB rate hike call from Deutsche Bank? Tons of it.
Yes, but they're not alone, because right now the ECB is facing some inflation that, frankly, is the fastest pace that they've seen in decades, and they're seeing this actually crimping growth. How do they respond to that? I do think, though, it seems hard to imagine at this point.
So that's the main focus of this program through the next several hours. What does all this mean for your market? Our team coverage on Ukraine starts right now with Bloomberg's Anne-Marie Hordern in Washington, Maria Tadeo in Brussels. Maria, let's start with you. The sanctions effort, where are we this morning?
Well, Jonathan, we are about to get an official approval to this new package that will be presented and put forward by the end of the day today from the European Union. We know what's in it. It's, of course, coal is the takeaway measure from this. It will be banned, so those exports from Russia going into the European Union. Buyers will now get 3 months to wind down contracts, and after that, they won't be able to buy new ones. We also know that about 10 billion exports of European technology going to Russia will now be blocked. A lot of this is really designed to increase the pain on Russia. But Jonathan, I would say this is the past. The conversation now is really quickly moving to oil and gas. And today we heard from the head of the European Commission, from the head of the European Council, say sooner or later we're going to have to talk about oil and then gas. That is the choreography. And there's already huge pressure, huge social pressure, especially after those pictures of Bucha, to tackle oil. And the reality is, Jonathan, this is very crude, but everything that we've seen until now, it's clear that this is not going to be the end. The invasion continues. continues. There's many other places in Ukraine that have been occupied by Russians, and Europeans know very well that this is not the end of it. We're going to see more images of that, and they need to prep already a new package in face of that.
Maria, you say that they're going to start to have the conversation about oil and gas. They've been talking about this for a while. When do we move beyond just talking about it and debating and hearing from Germany that's pushing back and actually moving to a realistic way to start doing this?
Well, you know, I think, first of all, and to their credit here, the Europeans just a few weeks ago really said and repeated energy is something that we're not going to be able to touch. And right now they're doing it, and it's openly on the table, and they use it. They use it publicly as a way to contain Russia, but they also do it in a way that it forces all of the European countries here, the 27 member states, to really begin to prep seriously contingency plans to a world where you don't import Russian oil and gas. Now, is this going to happen overnight, the switch off? Probably not, but if you ask me, is a political debate now on the table, and is it for real? I would say yes, and it's probably going to happen in the next few days.
Meanwhile, over in the United States, we do have this hearing, and Anne-Marie, I'm wondering what you're expecting to hear out of this with the oil executives who are basically being brought up to be pummeled for price gouging, and yet they want to also make a plea for more respect on the Hill.
Yeah, it's going to be interesting. And Joe Manchin had said he hopes that they get here anyway, but don't take their private jets. Listen, this is an interesting time for the oil executives, because at the same time, you have individuals in Washington calling them up, pleading with them to pump more and to go in and do the geology that's involved in trying to get those wells working. So on one hand, this is going to be a bit of a slap on the wrist, saying, from many on the left as well, and the Democrats saying, are you price gouging? What is going on in the market right now, especially when you do see days when the U.S. decides they're going to release 1 million barrels a day for 6 months of strategic petroleum reserve, and the oil price moves down dollars. Why are you not seeing as much of a hit at the gas pump? At the same time, there's going to be, I imagine, many on the right who are going to want to show that right now we should be investing, the U.S., in fossil fuels and in these oil companies.
I wish that these hearings were productive. I hope that this one will be. I fear it's just going to be a highlight reel of people running in the midterms later this year. I mean, look at the way this has been constructed. The title of this hearing, quote, gouged at the gas station, big oil and America's pain at the pump. AMH, haven't they already come to a conclusion on what they think is happening?
Yeah, and yeah, you're right. The title gives it away completely, but it is an interesting time, because how tough can you go on these companies and these executives when you really are trying to get them to help you? This is going to affect every single politician that is going to be running for re-election in November. What are people going to vote on in November? They're going to vote on how much it costs that day, the sticker price at the pump, how much it costs at the grocery store. These are issues that are affecting everyone, and this is beyond party lines, and these are the individuals that they need help from.
Anne-Marie, thank you. Down in DC alongside Maria Tadeo in Brussels. Bramo, it never changes the politics in Washington, does it? It would be nice if we had a productive conversation. I hope we still might get one. As I say, though, I fear that a lot of people asking the questions have already come to a conclusion.
I feel like you're less jaded than us in the United States, because you're surprised by the lack of productivity, and this theater of it almost becomes rote after a while, which is disappointing. You're right. And then we're looking at a scenario that's nuanced. We have to create a new energy system that relies on fossil fuels for the near term, even if we're going somewhere else over the long term.
I'm not surprised, just deeply upset, and always will be. Futures down 0.5%.
Who's
on
the bear
S&P.
now?
On
I'm
the
just
Nasdaq.
deeply upset and always
Down
will be.
0.8%.
Happy Wednesday.
Just with politicians, I just wish that they could just have a productive
I
conversation.
hear you.
Ask some questions, some back and forth. Yields are higher by 8 basis points, 262.75 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Russia's finance ministry says that foreign banks refused to process coupon payments of $649 million on its Eurobonds. So now the payments have been made in rubles. The ministry says it considers its obligation to be fulfilled. The US, EU, and Group of 7 are preparing to impose more sanctions on Russia. That's after the discovery of alleged atrocities in Ukrainian towns abandoned by retreating Russian forces. According to the White House, penalties will be increased on financial institutions and state-owned enterprises. Money market traders are betting the Fed raise interest rates by another 225 basis points by the end of the year. That would be the most in almost 3 decades. We'll get more of a sense of the Fed's thinking today when those minutes from the last policymakers meeting are released. China reported more than 20,000 new cases of coronavirus Tuesday. The increase was driven by surging infections in Shanghai, where authorities are building the world's largest makeshift isolation facility. A convention center is being converted to house more than 40,000 patients. And Jetblue has offered to buy U.S. budget carrier Spirit for $3.6 billion. That potentially spoils a competing bid by rival Frontier, and it could reshape the landscape for ultra-low-cost air travel. Spirit says it will evaluate the Jetblue offer. 2 months ago, Frontier reached an agreement to buy Spirit for $2.9 billion. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
We know that this policy is as accommodative as at any time when we have inflation this high, when we have labor markets this tight. So there's no question that policy has to be removed. I think 50 basis points is going to be an option that we'll have to consider along with other things.
Great to hear from Esther George, the Kansas City Fed president, sitting down with Mike McKee just yesterday from New York City this morning. Good morning. Futures are negative on the S&P, on the NASDAQ too. On the S&P 500, futures lower by 0.7%. On the NASDAQ 100, we roll over. We are negative by almost 1 full percentage point now. Yields higher again by 8 or 9 basis points to 263.32 on a 10-year after climbing yesterday by 15 basis points. It's been a big run-up on a 10-year yield this week. We closed out Friday at 238, and here we are at 263, Tom. What a turnaround again.
John, let's go with Damian Sassar right now. We've got to do that on Russia. It is falling apart as we speak. If you look at the intraday chart on their important piece, the 2042 bond, it's a 5 5/8 coupon, John, yielding out over 22% right now. Just since we started the show, it's gone 26.25, and I've got 26.25 down a point, and that's down from 28 just a couple days ago. These are off the headlines arguing about how Russia's going to make payments, I should say, and this dreaded D word is their default.
It's not about ability or willingness to pay, it's about the logistics. It's something Damian Sassar and I were talking about just yesterday, and this was the story this morning, that Russia's finance ministry said foreign banks declined to process coupon payments of $649.2 million on its euro bonds, and the payments have been sent in rubles. Tom, we're going back to a conversation we had a few weeks ago. What constitutes a default? If someone has tried to pay and it can't meet the investor, can't get through the pipes, so to speak, what is that?
Well, what it is when the market takes over. Now, I don't know if you're going to see it in ruble, and I don't even know if ruble's an artificial market or not, 84 on dollar ruble right now. But in the bond space, you can see it with any kind of pricing. And, you know, this 2042 bond is yield up, price down. That's a precursor to talk about the American markets. Eric Friedman is not looking for 22% yield. Chief Investment Officer, U.S. Bank Asset Management. Thrilled we could get an update this morning. Which desk are you hiding under, Eric? Are you under the cash desk? Are you under the 100% invested in energy desk? Where are you hiding this Wednesday?
We're somewhere in between, Tom. I'd say that our overall perspective is that this is not quite duck and cover territory, but we do think liquidity becomes a really important variable for investors to think about. So what are we doing? And we've actually been underweight fixed income as a category. We've been preferring to be a bit more cash flow diversified, meaning investing in things like reinsurance, things like infrastructure. Those have been good alternatives for us in the near term. But, you know, we do think that as we hear more conversations from Mary Daly and Lael Brainerd, that liquidity becomes an issue and certainly something we're thinking about for clients.
Eric, Ben Laidler in London publishes this morning, and he says, look, we screwed up earnings last time. We're screwing it up this time. Laidler makes very clear that the gloomy earnings outlook is overdone. Do you agree?
We agree. It's a little overdone in terms of the doom and gloom crew about earnings, Tom. We think 220 for the S&P at the operating level is very achievable. Market's more like a 225, 226. We actually don't think the earnings number is necessarily vulnerable, but we do think the multiple people willing to pay, that could be a variable people think about. So again, if you look at Fed funds expectations by December, we're talking 255, 260 in terms of Fed funds. That is a multiple equivalent of not 22, 23 times. That's more like 20, 21 at best. So that's a variable that we're certainly modeling and thinking about. But again, we think the headline earnings number is not necessarily material risk right now.
Eric, we've got to be thinking about demand destruction in this economy with energy prices where they are, with rates where they're going to be at the back end of the year, as you've just painted the picture for us. Energy stocks are up by 37% on the S&P year to date. Eric, today, they are going to get absolutely roasted on Capitol Hill. Do you want to stay with those names?
Jonathan, probably a migration from, let's call it front month commodities, guessing where the spot price of crude may go, migrating down to energy stocks, really more the MLPs and midstream energy. That's probably a better place to be in the near term. We do think that more sustained level of oil will be persistent. If you look at to your point, the risk of demand destruction, but also just the lack of supply mechanics. You have too few drillers out looking for oil despite a very elevated price. And of course, concerns from investors about chasing price. So we do think that migrating towards more cash flowing midstream is probably a better place to be in the near term than obviously where front month futures may be in crude.
Well, Eric, we've been talking all morning about this Deutsche Bank note that came out yesterday where they're calling for a recession now as their base case in the United States over the next 2 years. How much have you factored that into how you've arranged some of your investments?
Lisa, you had a really thoughtful tweet just about inflation writ large. I'll roll that into the Deutsche thoughts. I think that what we're seeing about inflation is really not a shift in inflation expectations. I mean, the change in yields has been more a function of real yield changes versus inflation expectations. So we do think the recession consideration goes up if the market does not think inflation will roll back. We do think inflation will roll back. It'll probably be a later this year, early next year type of phenomenon. So I read the note. I think it's a thoughtful piece of research. But the concern we have is really not recession per se. It's the strength of the near-term downside and acceleration of growth, meaning we do expect the back half of this year to show some resilience, but the first, next quarter and this quarter, we could be a little bit sticky just in terms of a base effect that is challenging for investors to think through. So we think recession out to 2023, 24 is a possibility, but we're more focused on the next 3-6 months where that base effect trade-off between what Fed may do and what markets expect is probably more important. So that's kind of the way we think about, more near-term risk than what may happen in 2023 and 2024.
You're so diplomatic, Eric. You call something thoughtful and then proceed to disagree with it. Eric Friedman of US Bank Asset Management.
Ripped that page out from the time.
Wasn't that perfect, TK?
Yeah, you did that well. Yeah.
So thoughtful. Thank you, Eric. Thank you very much. Just want to go, Lisa, and I am teasing you, of course. They are always thoughtful.
I'm going to use that. That was such a thoughtful point. I completely disagree.
I want to go to these comments from Senator Manchin ahead of these hearings down on Capitol Hill.
Oh, that must be something.
AMH just sent this line over to me. Here's a quote from him. I just pray to God they don't come here on corporate jets. That will be the first question that's asked.
Oh, come on.
I think he's suggesting that it's better
brilliant.
to walk or hitchhike, he said.
That's brilliant.
Isn't that great?
Rick Wagoner and GM in a car driving from Detroit to Washington years ago.
Let's see. It's must-watch TV a little bit later, that's for sure, from New York
Lisa
City.
has a Gulf Stream this weekend.
Oh, Futures down 0.6% on the S&P. For our audience worldwide, this is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Live from New York City this morning. Good morning to you all. Futures are negative by 0.6%. On the S&P, on the Nasdaq, we're down about 1%. Going into yesterday, since Chairman Powell spoke in the news conference on March 16th, the Nasdaq 100, through yesterday's close, even with yesterday's move lower, is up by almost 10%. Wow. So just think about that. Chairman Powell said exactly what Governor Brainerd said yesterday by talking up the rapid withdrawal of the balance sheet. Balance sheet reduction would be rapid, quicker this time because the economy was stronger. We heard that from Chairman Powell. And yet we still rallied close to 10% through yesterday's close, even with that move lower. Since that meeting, equities higher and the 2-year much higher as well by 70 basis points. So let's look at that now on a 2-year, 10-year, 30-year. Your 2-year right now up 5 basis points on the day to 256.53. 264 on a 10-year, up 9 basis points today. And Tom, up yesterday by 15.
The real yield, the 10-year real yield, John's gone 4 standard deviations, -2 through neutrality to +2. That's a huge, huge move. Is the market doing the work for the Fed? Are they getting near a 0 real yield for the 10-year, which solves a lot of the problems for Chairman Powell?
You don't have the Bramo cam, Tom. I do. A live shot of it. As you were speaking, the head, side to side, shaking.
Well, no, I mean, honestly, just you said, is the market doing the work for the Fed? It's not, because financial conditions are loosening. And I go to Bill Dudley's column this morning. He put out in Bloomberg Opinion where he basically said, if financial conditions don't tighten, the Fed's going to have to force them, which means stock prices lower, bond yields higher.
Look out for the minutes a little bit later this afternoon.
Several of us will read them.
2 of us, to be clear. 2 out of the 3 on this committee will be reading them. Let me finish here on the dollar, Tom. The strongest since May 2020, very close to a 100 handle, 99.57, up 4% over the last year, year to date, to be precise. Tom, let's go to that Deutsche Bank call just briefly, and we can sit on this a little bit later, a little bit more. But they're looking for 250 basis points of hikes from the ECB. Where does that leave this? 250 from the ECB, that would be huge.
This goes to Folkets Landau's worried about need for depreciation. David Folkets Landau not only acclaimed at Deutsche Bank, but also with his academics over the years with Michael Dooley. And John, what this amounts to is yield up, protect the euro. I think that's really where they're heading.
What do you think is going to happen to the Italian debt market, Tom, if they get rates up 250 basis points?
Well,
I mean, my question for David, Tom, would just be a brief one. Is this what you want to see from the ECB? Or what you think is most likely?
Yeah, well, and I would go even further and say cart and horse. Which is the horse, which is the cart? And the answer is, does the ECB get out front of this, or does the ECB follow along on an ex post basis like any other central bank?
I'd suggest just one final thing, Tom. This is a tremendously out of consensus call, and the majority of people believe still it would be very, very hard for the ECB to hike rates 250 basis points between now and their call from September this year out to December next year.
Robert Rosner joins us right now, senior U.S. economist at Morgan Stanley, to recapitulate the central bank chat and what it means for the American economy. Robert Rosner, when you and Ellen Zentner adapt and adjust, and when you see on the street Luzetti over at Deutsche Bank with a recession call 8 years out or whatever the call was, how far out can you people look? Can you make a guess for the autumn of 2023 now, or is that just impossible to do?
Well, thanks, Tom, and thanks for having me on. You know, certainly when you're looking that far out, certainly when you're in the kind of economic environment like we're in today, the uncertainty bands naturally widen as you're looking further out. So when we start to think 6, 8 quarters out, there's a range of outcomes that could hit the U.S. economy, especially when we're looking at an economy that is increasingly moving into the later phase of the cycle. That includes the Fed policy tightening, and that includes a labor market that's operating now at a very tight level. So that does increase the uncertainty as you look that far out. And now that we're looking further on into 2023, we do see risks to the outlook that are becoming increasingly two-sided as well.
With the Brainerd comments and this idea of rapid pace, are we getting towards the instabilities that we learned about, not in 2007, 2008, but out a number of years when we tried rhetorical experiments?
So, you know, Brainerd is flagging this rapid pace of reduction in the balance sheet. That's consistent with what we've heard from Chair Powell as well. We think that the minutes later today are likely to indicate that the FOMC is favoring a monthly pace of rundown, maxing out around $80 billion per month. The differences between 80, 90, 100 billion may end up being more marginal, because when we look at the balance sheet, if it were to just run off unconstrained, it ends up being not so different from our base case of that $80 billion a month rate. So they're basically running this thing down as quickly as they can, but there's a lot of room to go. And Chair Powell has indicated this process could take place over 3 years. Maybe if there's a risk to that, it ends up being shorter if they do end up seeing disruptions. But it comes back to a key point that you were talking about earlier with respect to financial conditions. This is a Fed that's trying to use its policy tools, both rate hikes and the balance sheet, to tighten financial conditions. They've made some room, they've made some progress on that, but there's still more room to go. Financial conditions, by our measures, remain about neutral, meaning they're neither supporting or restraining the economy. If the Fed wants to slow demand, they need to get financial conditions tighter, and the balance sheet is going to be an important tool to do that.
Rob, how are you thinking about the economic ramifications of quantitative tightening in terms of what the equivalent rate hike would be, in terms of what the equivalent tightening might be measured as?
Yeah, so we did some work on this back in the winter alongside our strategists to think about how different asset classes would move in response to the balance sheet and what that would mean in terms of financial conditions. And what we estimated was that the rundown of the balance sheet that we're anticipating this year is about the equivalent of 125 basis point rate hike. So that adds to the tightening that the Fed is doing with its traditional policy rate tool, but it is just one rate hike equivalent.
Given the fact that it's only one rate hike equivalent, is that enough given the pace of inflation? In other words, at what point do you end up with a recessionary call like Deutsche Bank versus saying that inflation is going to get a little bit unmoored in a way that perhaps people aren't prepared for?
Yeah, well, it's not enough on its own, and that's why the Fed has to pursue rate hikes alongside that. So we're also expecting 50 basis point hikes now at the FOMC's May and June meetings, and 25 basis point hikes at each meeting for the balance of the year thereafter. So 250 basis points of tightening for the year as a whole. Throw the extra 25 on there from the balance sheet. That's a lot of tightening for the economy, and that should have some effect in terms of tightening financial conditions. But there's an important point here, which is that the market has largely priced in that policy path already. And so the effect on financial conditions gets more